start, let me introduce myself to everybody that hasn't been to one of our classes or trainings or anything like that. But it's Mike Roberts, and I'm part of UME Assumption Specialists. My wife and I actually created the company. Yes, we live and work and 24/7 together. It's great. I have to say that because she's sitting over here in the office next to me.
Hello.
So it's fantastic. But so we've both been lenders for like 24, 25 years in Phoenix. And about 2 years ago, we're driving and trying to figure out what the new market of the moment was going to be. And Rachel was just kind of going through her Instagram, and we saw a lot of loan officers that we've trained and managed over the years, and they started touting the 3-2-1 buy down. I don't know if you guys remember that, where what was the expression? Date the rate, marry the house, date the rate was the expression. And that was where you would pay a bunch of money up front, and you'd get a lower interest rate for 1 year, and then it gets a little bit higher, and then it gets a little bit higher, and then it ends at a specific interest rate. So obviously a topic for discussion on another time, but we thought it's a terrible economic decision, the whole 3-2-1 buy down. And we're starting to see the fallout of that with some of these short sales and foreclosures that are hitting the market. It's kind of an emerging market here in the Valley, and I'm not sure if in Vegas if they're doing it as much. But we started talking about what's the new thing, what's going to come up. And Rach said that she's like, assumptions are going to come back. And I mean, I'm like, you mean like the real assumptions, like from like the 80s, that type of thing? She's like, yeah. And this is when rates had just started going up, and housing prices, we had a lot of appreciation here. And so we looked at it from a complete home affordability perspective, where you have a lot of these buyers that were sitting in the car, expression wise, sitting in the car with agents, and then they just ended up being priced out of the market as interest rates went up, the amount that they were qualified for went down, and then eventually they couldn't afford to live in an area that they would want to. And so we pictured that was going to be the market, and we're like, you know what? If someone can do an assumption and get an interest rate back in the 2s or 3s or something like that, they're going to be able to afford to move into houses again. And so we have a ton of those success stories where we've had families that were, no longer, they were stuck renting. They could no longer buy a house, but then all of a sudden they found a house, they had enough down payment, the interest rate was in like the 2s or 3s. So they're able to get into that house. And, we have this super successful, feel good story, which is what a lot of the major news carriers started covering and started reporting, of like all that feel good stuff for the home affordability. But what we've noticed over the past probably year is a little bit of a shift in that. And we've seen the market kind of tilt towards investors, because investors seem to be the aggressive group that self-educate, and they're looking for something that's an amazing investment for them. And when it comes to the residential real estate world, as far as investment, there's nothing better than an assumption. There just isn't, because these investors are able to get homes in the 2s and 3s, and they're able to cash flow. And with the current rates, nothing pencils out anymore, but with assumptions they do. So that's just kind of what we've seen. But we'll go through, and I'll go through and kind of explain to everybody more of the academia behind assumptions, as far as like what they are, how they work, give you all accurate information, because there is so much misinformation out there. If you Google stuff, a lot of times it's based on people's personal experiences versus FHA and VA's manual underwriting guidelines that are for assumptions. So we're going to give you all of the correct information. And I have Joe should be on here. He'll be monitoring the chat box for any questions. I absolutely encourage you guys to like stop me and ask questions. I like to make it a little more interactive. It's a little bit harder via Zoom than it is in person, but feel free to raise your hand or ask questions or interrupt me, because I'm happy to answer any questions as we go. Many times what'll happen though is you'll ask a question, and then I'll say, oh, that's a slide ahead or 2 slides ahead. It happens pretty often. So let's get started and go through what we're going to be talking about. So first thing I'll go through, this is pretty much all of the academia side of things. And then once we're done with this will probably be, I don't know, hour and a half or so. We'll take a little bit of a break. And then the next section that we'll do will be more, okay, now that you know about assumptions and how they work, what do you do now? Great, I have a buyer that wants to do an assumption. What's my next steps? How do I make money with all this assumption knowledge? That's the second part. First part here, we're going to talk about what an assumption is, which loans are assumable. Why are you just hearing about this? Agents ask me that all the time. Is this a new thing? Why should I even care about this? Is this just kind of like trying to find unicorns? It's a market that's not going to last. Is there really a market for this? And then the part where I put what's the catch? I've had numerous agents repeat the class because they go and talk to buyers and sellers about it. And for buyers and sellers, it just sounds too good to be true many times. And whenever something is too good to be true, a lot of people shy away from it, right? Because then it probably is, but in this case, it is not. And then I talk about really where does you, me fit in? Like, where do we fit in as an assumption processing company? And then the final part here is always where it's really the aha moment for buyers, sellers, agents, is when you show the economics behind an assumption, and really the numbers and the savings that are involved. So let me actually, is there anybody out here that has experience with assumptions? Has anybody done one, in the middle of one, have an assumable listing you don't really know what to do with?
I have a listing that I've been struggling with that I think would be perfect for assumable. And so that's why I'm here.
Okay.
And
Sarah,
what's
the address for your listing?
6117 Star Point, all one word, Star Point Road, North Las Vegas, 89031.
Okay.
It's a VA loan. The seller will not be purchasing again. It does have solar. That's the big caveat. It has appraised for what we've been getting it under contract for, but it's been falling out because of buyers not being able to qualify literally at the last second.
Okay.
And it is pre-foreclosure, but because it is a VA loan, they said, we have not gotten a sale date yet. They said, that's going to be a little while. So now I'd like to see if we could perhaps get it closer to the price that we need it to be, but have it be assumable, even if it took like 60 to 90 days.
Gotcha. I'm looking over, if you see me looking over here at Rachel's screen. So it looks like it's you have it listed for 525 and it's about $100 and something thousand down, $113,000 down. Does that sound about right? So I think that they would owe about 410 or something like that. Okay, so perfect. We'll go through some of that. Anybody else with some experience? We'll go through that like when I get to that portion. But
Yes.
Anybody else with experience?
Well, I don't have experience, but I have another listing that she's got a 2.75 interest rate. And we already talked to her lender and they said it would be 45 days to do it. But and I thought that would be a great selling point, but so far we haven't had anybody.
Who's the servicer?
Mr. Cooper.
Okay, actually we have a good relationship with Mr. Cooper, and they will not be 45 days. They always say no, not even close. Mr. Cooper won't. The reason why, the reason why, if you call in and ask how long it's going to take, all these servicers are starting to just say 45 days. They will say 45 days, and the reason being is by law it has to be 45 days, but none of them adhere to it.
Wow.
So that's just that's an FYI.
Okay.
Sometimes what they do, and again, I'll get back into the assumption side, but sometimes what these servicers will do is they'll say, oh, it'll take 45 days, because technically they have 45 days to process the assumption from the time they receive all the information. So many of them, what they do is they just don't receive it.
I love it. Okay.
So, and then they receive it and then they do 45 days later. So, okay. And then what's the address on that one, Diana?
It is 7364 North Decatur, Unit 4. It's a townhome or condo.
Okay.
They had them as townhomes and I think they switched them condos.
Okay, so condo question mark. Okay, got it. We'll look that up in a little bit here too.
Thank you.
Okay, perfect. Okay, so let's talk about, first of all, for those that are not at all familiar with assumptions, what is an assumption? And whenever I talk about what an assumption is, I talk about what it's not. And if you're on the listing side, it's not those first 5 or 6 phone calls that you get from what I call TikTok investors, where they're like, hey, I want to assume your loan because I just realized I could make, I could build a real estate empire with 0 down. And I'm going to assume your loan. When in actuality, what they mean is they're just going to assume the the responsibility for making the payment on the loan, not actually assume the loan. And that's that whole subject to and wrap and contract for deed arena. And that's where someone comes in, they'll take title to the house, they'll give you X amount of dollars down, and then the seller stays on the loan, and then the buyer just they just make payments on that. And that's where you hear about some of the nervous nightmares of like, what if the bank finds out about this, and then they'd use the due on sale clause to call it due. That's the subject to wrap world, and there's a place for that in the market, but that's not at all what we deal with or what I'm going to talk about today. What I talk about is all the legitimate government mandated, release of liability for a seller by law assumptions. And it's any government loan is eligible for it because it's written into the security instrument. Basically, the government put that together for we the people, and then even more specifically for veterans on the VA side, because it gives veterans an advantage when they're selling their house that they can offer their loan and a lower rate. And we'll get into some of those drawbacks, which is, that VA entitlement piece. So the VA entitlement piece is probably the only really confusing point to the entire assumption process. And I think, Sarah, you mentioned one of the key pieces you mentioned is my buyers or my sellers not going to be buying another home. Is that right?
That is correct. Yes.
Okay. So really, I think what you were referring to is the entitlement piece doesn't really matter for them in this case. And I'll go through that in a lot more detail a little bit later on. But again, when it comes to assumptions, that's the key confusing piece in the entire market. So, okay, so let's also talk about, government loans, FHA, VA, and USDA. USDA's terms for assuming, they really kind of take away the entire benefit of doing the assumption. If I remember correctly, it's you actually have to take it over at current market rate, which again, defeats the purpose of an assumption. So we don't really talk about USDA at all, or even address them. FHA, super straightforward. FHA is primary only, but VA is eligible for investors, primary, non-veterans. So to make it very, very, very clear, because you will see a lot of bad information out there, you do not need to be a veteran to assume a VA loan, and you do not have to have it as a primary residence to assume a VA loan. 100% correct. Now, you'll have some people say, oh, well, you have to, in order to get a VA loan, you have to be a veteran. That's on the purchase side. If you are buying a house, you have to buy it as a primary, and you have to buy it as when you're getting a new VA loan, and you have to be a veteran, plain and simple. Questions I get all the time are like from people looking, and they're, especially when they're a little dubious of the assumption market, is this really a market? Is it a fad? I mean, are there only a couple of houses out there that are assumable? So is it kind of a waste of my time? So remember, since all government loans are assumable, and per the CFPB, Consumer Finance Protection Bureau, about 27, some water, per chance. So about 27% of all the home loans out there in the US are government loans. That means 27% of all the loans out there are assumable. So you have about a quarter of the market is assumable. And you'll see that, and I'll show you a little bit later our website where it has all the assumable loans in your guys' market. You'll see about a quarter of the market right now, MLS, is assumable. And then another question, thank you very much.
Talking too much over there.
I know, it's too much talking, right? But you have another question I get from people is, well, is this a new thing? Why haven't I heard about this? This is brand new. Did this happen over COVID? Did the government just come up with this? It's been around forever. Ever since, I don't know, was it the 40s and 50s when VA and FHA were created, or their home loan guarantees were created? It's been like 40s and 50s. Now you haven't heard about it because if you see here, this is the last time it was popular, and that's in the 80s and 90s. So let's say, for example, in 1982, you're going to market, right? And you can get a loan at 17% right here. But someone else got a loan a couple of years ago at 10%. And you're like, wow, I can assume this 10% loan instead of a 17% loan. So that was a huge benefit. That's the last time this was popular. But if you see here, what is that, 1982 or 3-ish? Ever since then, rates have been going down. So it's never going to make sense, well, actually, every once in a while it does, and I'll go through the specific examples, but it's not going to make sense to assume someone's rate if it's higher than what you can get in the new financing market. But now that we hit bottom right around 2020, 21, and 22, and you had rates in the 2s and 3s, now all of a sudden rates shot up to the 8s, and now they're back down to like around 6-ish. That's why they're popular again, and that's why you're just now hearing about it, is because it makes sense to assume a rate in the 2, 3s, and 4s versus taking new financing and in the 6s. And another reason why you don't hear too much about this, or even on the opposite end of the spectrum, it gets poo-pooed all the time, is realistically the best advocate or the person to help navigate an assumption is going to be a very experienced loan officer. And the reason why that is because an assumption it's all assumption guidelines. It's all like the deep down nitty gritty VA and FHA guidelines, but they are assumption guidelines versus new financing guidelines. They're two completely different animals. And to navigate through that, you really need like an experienced lender. But the problem is a lender makes no money. There is no new loan in an assumption. You are assuming an existing loan. So there's no new origination, and lenders make their money on new originations. So if you have, let's say, for example, you've got a buyer that goes out and they're looking at 2 separate houses, and they're like, say they're both 600,000. So one's 600,000 and it's not assumable, and one's 600,000 and it is assumable. And you have an assumable rate at like say 3%. And then he's pre-qualified through his lender and talks to the lender, and he's like, hey, I have an opportunity to get this house at 3%, versus 6% on this new financing. And the lender's like, whoa, those assumptions, they take a long time. They're really difficult. From what I've seen, only about half to maybe 60% of them actually get done. You get started, the lender denies you. You never know if you're really going to get the home. So they discourage it. Because again, they lose money and they lose a client if they go out and they do an assumption. So that's one big reason. Another one is, if you guys remember the short sale days, those were the times when you had agents, especially at first, they were like, oh, I'm not going to deal with this new thing, this short sale foreclosure thing, and trying to deal with Bank of America before they even had Equator. And, if you guys do remember those old days. But you will see that it's all that fear of the new thing. But those agents that really took to short sales back in the day, they started killing it. And a lot of them are the big agents now because they built teams around that. And we're seeing that in the assumption market now, is those agents that are really grabbing onto or gravitating towards assumptions, and not necessarily doing their entire business, although we do have some that are doing their entire business around it. But the ones that are taking that idea and putting those arrows in their quiver, they're the ones that are being super successful. They're the ones that are, doing 1 or 2 or 3 or 4 or 5 more every couple months. And so I've actually got a good story of one of our agents that have done this, but another big advantage, like why should you guys really even learn about this? Again, is there really a market, etc.? But your clients will ask you about assumptions, plain and simple. Probably 6 months ago, they wouldn't, because it wasn't a big thing. But now you see there's like TikTok videos, there's YouTube videos, there's news stories like, hey, have you seen the latest mortgage hack, and all that kind of stuff. And it all revolves around assumptions. So your clients are going to ask you about it. So you want to be able to answer, all of their questions, or at least enough. For example, if you wanted to get them over to us to talk to us to get all the nitty gritty and the granular details. But you want to be able to speak intelligently about assumptions, because it is a thing that's coming in the market and it's becoming much more popular with the general public. Another big thing about this, though, is, I've been doing this 25 years, and I have never seen a bigger win-win in the industry ever, of any type of financing or short sale stuff or any of that, because your buyers win. They get lower payments, lower interest rates. Your sellers win, because they sell their house. Okay, let me change my verbiage. I always used to say sell their house faster. They get their house under contract faster. The processing time may take a little bit longer, which is normally like 60 to 90 days, with about 80% of those servicers, including Mr. Cooper. Like, I know that Diana, you were saying Mr. Cooper says 45 days. And There's a bunch of places out there that say, oh, we'll get it done in 45 days. They don't. And we know that because we do have, we spent probably the first 8 months of our time being a company creating relationships with the higher ups at VA and creating relationships with the higher ups in the assumption departments at all the major servicers. So we know like the players out there, and we know how quickly they're getting these done. So in 45 days, it happens every once in a while, but again, that is not a standard out there. It's supposed to be, but it's not. So sellers can get under contract faster, so they're waiting a little bit longer on the processing side, and they normally will get a higher price for that house because a buyer sees that lower payment or sees that lower interest rate, and they see value to it, so they'll pay more. And just as a kind of one of the things we've seen in the market, and I'll show you some examples in just a little bit here. Sometimes it gets bid over ask, but most of the time in the assumption world, from what we've seen, people come in, full price offer, no concessions, and then they just want to get under contract. And again, you wait a little bit longer, but you don't have that house on the market for 45, 60 days, and then have to have that tough conversation of doing a price enhancement. So another one that's like, what's the catch? Has anyone interfaced? I know Sarah, Diana, you guys talked about, have you guys interfaced? You said either with Mr. Cooper or a lender, and have they told you any information that it didn't seem right or anything like that?
No.
You hit it on the head with what you said. I have a preferred lender that I absolutely adore. And when I started talking to him about this property and about it being assumable, he kind of just like brushed it off. And it was exactly to your point, because he couldn't make any money off of it. So I attempted to. So no is my short answer.
Right. Okay. So one of the other things that you will find, so a lot of people that go about this on their own, they just don't know what the real rules and the real guidelines are for assumptions. And you will find that I don't want to say all because that's absolute, but many to most of the servicers, they act like insurance companies. That's the best way I can say it. They act like insurance companies. You go to the insurance company, you make a claim, they say no. They just keep telling you no until you finally go away. And an example, I gave a couple examples on this slide, and this was a while ago. We had one servicer, and this is before we got involved. The parties didn't know about us. They kept telling them that no, you can't do an assumption without a hardship. So the seller called in and said, here's a purchase contract. Here, I want to get this started. And the group there, the assumption department, said, okay, well, what's your hardship? And the seller said, I don't have a hardship. And they're like, oh, sorry, well, your loan's not assumable if you don't have a hardship. And of course, they just said, okay, shoot, I didn't know that, right? And that kills the deal. So what happened there was, because when we got involved and turned it around, all of these servicers, they're starting to build assumption departments, but they didn't have assumption departments, because why would you have a department that would sit around for 40 years doing nothing, right? So all of a sudden they started getting these assumption requests, like all these requests started coming in. And they're like, oh shoot, now we got to figure out how to do these assumptions. And I guess we got to give these to somebody. And like, for example, PennyMac, they had 2 guys, that's it, nationally, 2 guys that were inside LOs, so your call center LOs, that really weren't doing much of anything. And they're like, you're our assumption department now. And so they just started dumping these assumptions on them, and they had no idea what they were doing at all. So this particular company, what they did is they said, who's slow within our company? Oh, you know who's slow? Is our loan modification department. They're slow. Everybody's got equity. There's not many loan modifications anymore. You're now our assumption department also. So when that seller called in and said, I'd like to do this assumption, your loan modification department is hardwired to say, what's your hardship? Because to do a loan modification, you have to have a hardship in order to do a loan modification with a lender. So they were hardwired to say that no hardship, we can't do it. And then we had to turn that around. That's not true. One that has been prevalent forever. And we've had this, like Carrington Mortgage, we had battles with Mr. Cooper, and I can give information on Mr. Cooper with this one too. Again, because we have a lot of the relationships within those groups. And And who's another good? Huntington Mortgage is another crazy one, but they say you cannot do an assumption as an investor. Sorry, your assumption is denied because you have an investor. Now, I talked to one of my agent friends here in the Valley in Phoenix, and he was super dubious of this whole assumption thing. And his seller had a loan with United Wholesale. So United Wholesale Mortgage. And I kept telling him, like, these things work, we'll push it through, we'll make it. I'm telling you, this happens. And his seller was getting more money for the house. His name's Jeremy. And he's like, okay. He just doubted the whole thing, like too good to be true. So about 3/4 of the way through the transaction, the seller gets a letter from United Wholesale that says, hey, we're sorry, we have to deny this, your assumption, because the buyer is purchasing this property as a rental unit. And so, of course, the seller freaks out, goes to Jeremy. Jeremy texts me a picture that just says, yeah, is this really part of your process too? And what I said was, yes. I mean, believe it or not, we get these denial letters all the time. We're used to them because that's what everybody gets in the transaction. Because again, the servicer's hoping you just go away. So a week later, we ended up closing that. So it's one of those things where these servicers will push back quite a bit. So the investor thing is a big one. No secondary financing. That's not true. It used to be true-ish because some of these servicers found a loophole where they said, oh, the second has to be assumable. But incredibly, and maybe this is a conversation for another time, but Rachel flew out to Florida to get in front of the head of VA's home loan guarantee to talk about this specific issue. And she was able to get VA to move nationally and put out a circular that clarified this, because this was hurting the veterans. So we were actually able to get VA to clarify one of their rules and create this rule when normally that takes an act of Congress to get done. So these are some of the things that make an assumption harder, is the servicers effectively just saying, no.
So what do you do when they say no? How do you push back if they say we can't do it and they've denied it? Now where do you send the buyer?
So for us, that's our everyday. We get the denials all the time. The thing is, the big difference between, say, for example, the short sale market back in the day, and that's when banks were looking at that and they have to make business decisions about, am I going to do this short sale or not, right? This is totally different. So the assumption world is by law. These servicers, and whenever I say servicer, I say it over and over, that's just the seller's current mortgage company. That's the servicer. So servicers have to do them by law. If you have a qualified buyer and a willing seller, there is no option for the servicer. They don't have the option to say no. They just don't. But they don't want to do them. None of these servicers want to do these because they lose money on every single one that they do. An example would be, because the government regulates how much they can charge to do it. So for example, with VA, I think in Vegas, the total amount that they're allowed to charge is like $763. Plus a $75 credit report fee. So you cannot create and run an efficient department off of call it even like $900 a file. You can't hire loan officers, processors, closers, funders, underwriters, etc., in order to be profitable. So they lose money. That's why they understaff, they overwork. There's incredible amount of turnover within these, so-called departments, and they just don't put their best employees in there because.
This rule.
Oh yeah,
Why would you
yeah,
ever?
yeah. The same thing. It's similar. Yeah.
So, okay, I think Anastasia. Let me see. There. So like, why would you ever want to become more efficient in losing money? But to answer, I guess, Diana, hopefully that was a long way around answering your question, is because they have to do it. We know the rules, so we know they have to do it. So we just make sure that they understand that they have to do it.
So are you saying that we go through you then? I didn't understand that. So I think that's where my confusion is. So
Gotcha.
We get you involved. Is that what happens?
Yeah. So the way that,
okay,
I'll kind of go through kind of where we fit in. So where we fit in as an assumption processing company is again, just like the old days of the short sales, you had those or the short sale processing companies that had the contacts within the banks. They're able to get things done faster and more efficiently. We kind of like fit within that space in the assumption world. So we basically do everything for everyone when it comes to the assumptions. People that try and do it on their own, that's where you start running into like that success rate of 50 to 60% or so. So we do a lot more on the front end to make sure that the person is qualified that is doing the assumption for the specific property. So like Sarah, in your case, Diane, in yours, if you guys both have listings, we call it pre-screening versus pre-approving. On our lending side, our mortgage side, we call it pre-approval, just like everybody else. Hey, we're going to get pre-approved for a new financing mortgage. On the assumption side, totally different set of guidelines, totally different set of rules. We do pre-screens for buyers to make sure that they will be qualified for this mortgage, this assumption, before we ever even get started. Because the last thing you want to do, especially as a listing agent, is talk to your seller, say, hey, I just got a pre-qualification letter from this person that wants to assume your loan. They're qualified, but it's new financing, which is worthless in the assumption world, that pre-qualification is. And then you're 60 days in, and then Mr. Cooper comes back and says, yeah, sorry, this person's not qualified. And you just lost all of that marketing time. So that's one of the reasons why you see a lot of failures.
I do have a quick question. I've heard that the buyer would have to qualify for the same guidelines that the seller did when they originally got their loan. Does that sound correct?
No, that's not correct.
Okay.
So again, when the buyer got their loan, I have actually seen something like that. I don't know if it was on the internet too, but that's not true. So what happens is that's a new financing type of thing. And new financing, realistically, most loan officers don't really understand even manual guidelines, much less the assumption side of manual guidelines. Because loan officers in today's world, what they do is they input all the information into their LOS, their loan operating system, right? And then they run it through an automated underwriting system, which is LP or DU, and it spits out and says whether you're approve eligible or accept, right? So and then the loan officer says to you guys, here's a pre-qualification letter. They're qualified, go out and find a home. In the assumption world, none of that AUS exists. There is no automated underwriting system. That just none of that works. It's all a very like 1980s carbon paper type of manual underwrite thick file type of stuff. So it's a totally different thing. So when someone had purchased that house, they most likely went through the automated underwriting system. And they, for example, if you're purchasing a house as a veteran with a VA loan, had to be primary residence. You had to stick to specific debt to income ratios, but that's not how the assumption world works. It doesn't work that way.
So would you then help the buyer, because there's always something left, the equity that's in the house. Would you help them then get that secondary financing?
What do you know? Thanks for the layup to this next slide. So the way that works, and again, it's kind of like that, what's the catch part two here. So the assumption world, again, is not like new financing. It's not zero down or 3.5% down for an FHA loan, or 5% down, or 10%, or 20, or for investors, 25% down. That's not how the assumption world works when it comes to down payments. So a down payment in the assumption world is simply whatever the sales price is minus whatever the assumable first mortgage is. So I think in Sarah's case, and I just remember just off the top of my head on StarPoint, it was like a $550,000 sales price. And then I think it said $112,000 down on our website. So that means they probably have about a $440,000 loan. So it's literally sales price minus the assumable loan. That is your down payment. Now, to answer Diana's question, hey, can they get some sort of secondary financing? If you're purchasing the property as a primary residence, then yes, we know of conventional financing out there where you can get a second mortgage. It's just like the old days of, if you guys were around during the whole 80-10-10s, that's when people would do an 80% loan. They would then take out a second mortgage to avoid MI, and then they would put 10% down. Same theory. You can have somebody get a home, they have to put at least 10% down, and then they would assume that first mortgage, and whatever that remainder is, they can get that in a second mortgage. And we'll talk more about that actually pretty quickly here. So now, if you're not doing secondary financing, like for, say, for example, investors, I don't know of any secondary financing that will go above like a 70% loan to value for an investor. So if an investor's putting the entire amount down, there's no appraisal needed. It's a great thing about assumptions, because you'll find some opportunities, and in a little bit here, we'll look on the website and kind of look through some of your guys' opportunities there, but you'll find some opportunities where it might be a $400,000 sales price and a $370,000, assumable mortgage. So it's really it's not even 10% down there. So you'll see those opportunities, and there's no appraisal needed, which means you don't have to worry about it not appraising. Because I think, again, Sarah, I thought you mentioned, oh, well, it appraised for whatever the purchase price is. In the assumption world, none of that matters. But if you do get secondary financing, that secondary financing person will most likely require an appraisal, because they say, we'll give you secondary financing, but you need to have at least 10% skin in the game. However, and we don't run into this very often, but it is possible, you're allowed to do it. You can get a little creative in the assumption world. Seller carries. So let's say I have a house right now it's a fourplex, and this is super uncommon. It's a fourplex, and it's a VA fourplex where the seller is willing to give up his entitlement. We'll get more into that, but the seller is willing to give up his entitlement, so an investor can go in there, or a primary residence person can go in there. But it's like a $660,000 purchase price, but it's $180,000 delta, which is a lot to put down. But what the seller has said is, if you put down at least 100, I'll carry 80,000 of it. So he'll basically act as the bank for that other 80,000. He just wants 100 to go do what he wants to do with. And then he says, I'll be your bank for the second mortgage for the 80,000. So you're able to do that. I mean, theoretically, if you found a $500,000 house with a $400,000 assumable loan, and that seller was like, I don't need any money right now, I just want to get out from under this house, sell it to you on an assumption and says, I'll carry the 100,000 and you just pay me like 7-8%. So he has a note that he's making money on. Theoretically, that's possible. So you could have someone come in with zero money. So here's, again, this is the biggest, I guess you would say, catch is the best way to put it. The biggest catch to the entire assumption industry, again, is educating selling veterans and having them understand their eligibility and entitlement. FHA is super straightforward. FHA primary residence only. And if a buyer comes in and assumes a VA or an FHA loan, the seller goes off of that loan and the buyer goes onto that loan. It's now the buyer's loan, and the seller's gone. If it goes into foreclosure, missed payments, none of that matters. There's no due on sale clause to worry about. That's the whole sub 2 market. It's very clean, easy, straightforward. VA is the same from a liability perspective. Buyer goes onto the loan, seller comes off of the loan. The buyer is no longer liable, or the seller is no longer liable at all for that loan. If it goes into foreclosure, no big deal. If it goes late payments on it, no big deal. From a liability perspective, meaning the veteran is never going to have to come back and pay, or it's never going to be a big problem for them when it comes to any sort of collections, bad credit, or anything like that. The only difference is a veteran, and without turning this into like a VA home loan class, kind of talk about how VA home loan or home loan benefits work. So VA home loan benefits are broken up into two pieces. You have eligibility and you have entitlement. So if you think of it like a credit card, like if you went down to Chase and you applied for a credit card, the Chase comes back and says, yes, you're approved, or no, you're not approved. That's eligibility. Yes or no, you are approved for a VA home loan. Like you have enough service time in, so where you're eligible for a VA loan. Same thing. Yes or no, you're approved for the credit card. The entitlement is like the credit limit. So yes, you're approved for the Chase credit card, and this is your entitlement. This is your credit limit. So same thing with VA home loan benefits. Yes, you can get a VA home. Your entitlement is how much can you actually get? Like what's your credit line? Now, entitlement is broken up into two pieces. So entitlement's broken up into basic entitlement and bonus entitlement. Basic entitlement is, and I know that there's a variance between some veterans, but in 25 years, I've never seen anything different than basic and bonus, and they're all the same credit limits, basically. And I know it exists, but I just haven't seen it. So it's very, very rare. But basic entitlement, it used to be, you know, many years ago, like 15 years ago, you could only get $750,000. So a VA person buying a house with VA could only do $750,000, period. And then it changed to $1 million. And then it changed to whatever the conforming loan limit was. And now, as of, I don't know how many years ago, 7 years ago, basic entitlement covers whatever you can qualify for from an income and credit perspective. So to give you an example, there was a house we saw that was for sale for $4.5 million, and it had a $4 million VA loan on there at 3%. So, which was crazy. I mean, if you think of it from a lending perspective, oh my gosh, a $4.5 million home, $4 million VA loan at 3%. Someone buying that house only has to put $500,000 down. I know it seems like a lot of money, but from a percentage perspective, it's 12.5% down, and they get a 3% interest rate. In the super jumbo world, normally it's like 7% interest rate with 20 to 25% down. Just that the savings monthly for them was like $17,000 a month in payment. Crazy savings. But I'm just using that example to show that it's a $4 million VA loan, so that it's a very, very large loan. Now, if a more common one is someone has like they bought a house for $350,000 using their VA benefits. And so let's say their original loan amount was, so call it $360,000, because you add on the funding fee that VA charges. So you have an original loan amount of $360,000, and now they're going to sell their house, and who knows if they're selling it, say, at $400,000. Well, if they allow a non-veteran to come in and assume that loan, their entitlement it's called encumbered. It's VA's term for basically being tied up. So they encumber that portion of their credit limit. So let's say it's $360,000. It doesn't mean, because one of the biggest myths out there is you can only have one VA loan at a time. Not true. It doesn't mean that that selling veteran can't go out and get another VA loan. It just means that they have a limited amount of credit left that they can use to get another VA loan. And I'll go through those numbers in just a little bit here. So let's look at, okay. Let's do some actual property examples so you guys can see. Let's pop out of this real quick. All right. And I'm going to share a new screen. Which screen do we see now? Let's see.
Same screen.
Okay, let me share.
I haven't seen any slides.
All right, let's do this one. Let me share this screen real quick. Share screen. And let's go to. Okay. So we're up here. Can you see where it says Amberwood?
No.
Hang on.
Right. Oh, let me scroll up. Right here. Are we on that screen?
No.
Loan details Amberwood. Okay. So here's a great example of this was a property where the listing agent knew, he was very familiar with assumptions. He had gone through our class, and he went out and marketed this property. This is a listing he had. And he did great with this. It was crazy how he was able to, when you have the listing side of an assumption and you know what you have, you pretty much have all the control from a listing agent perspective. So this house was, it was already remodeled. It was a fantastic house. It probably would have sold just as easily in the regular market. But what Steve did, the listing agent, he's like, all right, listen, talking to the market, hey, market, you guys have 4 hours on this day to come see this home, and that's it. And we're going to accept an offer from that 4-hour period. So he generated a ton of buzz just with that, because he had an amazing home and he had a 2.375% interest rate.
Michael or
Yeah.
Mike, I'm sorry. I don't know if is everybody else seeing the screen? Because I'm not, and it may be my system.
Yes, I'm seeing it.
You're with me.
Okay, so you see where it says loan details? And
Nope.
what are you seeing?
Just you with the your logo on the back.
We haven't seen any slides.
Does that, I'm seeing it. Someone says they're seeing it. So it
I'm
might
seeing
be.
it.
You have to
Okay.
change your setting at the top where it says like your screen settings. That's the reason.
Okay, hang on a second.
Okay.
Bad eyesight. I'm doing this on where's screen settings? I have views. Where would be screen settings?
It would be views.
Yeah.
View. Okay. I hit view. And then I have gallery. Some help, hidden self view,
Hide self-view, hide video participants,
showing.
timers, full screen.
That's all I have. So it's just us. Don't worry about it. Sorry about that.
Let me see if I can. Maybe if I move it over, let's see if you. Do you happen to see it now?
No, but that, again, like I said, unfortunately, I didn't have my tech. He's stuck in Costa Rica. Uh,
Okay.
But Avita, do you see where it says Mike Roberts screen at the top of your screen?
Robert screen. Huh? Down there? No. No, I don't see another screen that says Mike Roberts on it.
That's all I got.
Let
I
me
know.
try here. I'll try something a little different here. I'm
No,
just-
it's probably us because, like I said, I just stuck my laptop.
Perfume museum.
How
So
about that? Tell me if you see that.
yeah, just still see you.
You
Anybody-
have it on gallery?
No, I took it off gallery and put it on speaker.
Put it on
And-
gallery.
I did that. I did gallery and I don't see another screen. I was looking for
Okay.
that.
All right.
That's all right. Thank you for the, I mean, you know,
Okay, so
Lawrence Lynn, you should have been in my office. You could have probably solved my problem. All right. No
All
problem.
right.
Sorry, Michael. Continue. I didn't mean to interrupt, but I was just trying to figure it out.
Sure, no problem. So here, I'll go through this now here. So you've got the property that was listed at 695, and let me shrink that down a little bit so I can see it a little better. There we go. Everybody see that fine now?
Yes.
Okay. So 2.375%. The existing VA loan was $403,000. List price $695,000. What does that tell everybody? What does that tell? What does that mean for a buyer? If you have a $695,000 list price and a $403,000 loan on it, what's the down payment for a buyer?
292.
292,000, right? And the first thing a lot of people think, and to be honest with you, when we first started doing this assumption, the industry side of things or the market, how many people realistically are you going to have that are going to have almost $300,000 to put down on this house? Well, he marketed it great. We had 19 pre-screens, because remember how I said we do all the pre-screening ahead of time? He put on his listing, must be pre-screened through UME, so we know that they're qualified for the assumption. We had 19 pre-screens, 13 of them moved forward, and of the 13, 11 of them were doing it with no secondary financing. You'll see I have a secondary financing column here to show you the economics. And then of those 11, it boiled down to 4 buyers for a highest and best. And I'll show you why. If you look at the comparison for the economics here, if you look at a $403,000 loan at 2.375%, and let's say, for example, this person had to get secondary financing, this interest rate, which we'll talk about a little bit later because it freaks everybody out. This is the second mortgage. It's actually closer to 9 here. But your blended rate is going to be 4.91%, even on that secondary financing with 10% down. And so if you look at a down payment of $69,500 versus current market $69,500, you're saving almost $1,000 a month alone with the same amount of money down by doing the assumption and taking the secondary financing. But here, the highest and best, the 4 people, they all had more than $292,000 to put down. So that market is out there. People find the money. And when I say people find the money, I'm not talking about someone that found $5 or $10 or $15,000 because they could, you know, put that together, or even 40, 50,000. They're finding hundreds of thousands of dollars in this market. We had this was a great one. So we had a young veteran couple, and they were, I don't remember how old they were, like 25 or something like that. And they're out looking at houses, and they found one that happened to be assumable. And it was like, they weren't looking for assumptions. They were looking for houses, happened to be assumable, but the down payment was like 100,000, and they don't have that. Well, the dad found out that it was an assumable loan. The dad had done assumptions back in the day. He like bought his first house on an assumption and was like, if you guys do an assumption and you get this interest rate, I will give you the $100,000. And it was just, and again, it's not everybody has like relatives that have $100,000, and it's just crazy where these people find the money, but they find it. And so they have the money to put down. It's crazy. So what happened with Steve is his seller was super nervous when she got these offers, and, you know, oh my gosh, it's going to take 90 days in order to do this assumption versus I'd rather have a 30-day close. So I'm going to send out a highest and best. I want your highest and best on a 30-day conventional close, and I want your highest and best getting the assumption. So when they sent that out to everybody, the 4 people sent back their highest and bests. 3 of them, their highest and best on the 30-day close with regular conventional financing was 0. They did not want the property unless they got the assumption. The only person, there was only one person that sent in a highest and best for both, and there was about a $50,000 difference in their offer price. So they were saying, like, he was valuing that assumption at $50,000, even with that much down, which is just, it was crazy. So it eventually sold, and it went to highest and best. The property sold at $750,000, and this was probably market value, $695. And when I say market value, that's what an appraisal probably would have come in at. It's right around there. But again, we didn't need an appraisal. So $750,000. It actually recorded at $737,000. I think that they did some sort of thing within the buyer's inspection, got a credit. But that said, if you're at $737,000, that means that person came in with a lot more than that, a lot more than $292,000. So they have the money. Let's show one. Yeah, Badgett. Actually, I like this one a lot. So again, after Rachel and I started the company, and we became the experts at this, established relationships with servicers, and we were like, okay, we're ready to really go to market with this. And it's like, well, how do you go to market with assumptions? So the first thing that we did is we started calling, basically cold calling listing agents that had great assumptions during a time when nobody knew anything about assumptions. So this was, I called the agent on this property. And I don't remember when it was early summer of last summer, early summer. Houses were still selling relatively quickly. And I sat there and I said, hey, you know, Twyla, this is Mike Roberts. And, you know, I've been here in the Valley for a long time. So I think she knew I was a lender. And she's like, oh, well, I've got my lender sitting in the car with me. We're driving to Tucson. I'm like, okay, great. That's awesome, Twyla. But you have a listing on Badgett. That's an amazing assumption. Oh, well, I'm here with my lender right now, driving to Tucson. I get it. And I appreciate that. I'm not calling as a lender here. I'm calling basically as we started an assumption processing company. Oh, my lender's great. I've used her for, I'm like, okay. So the conversation didn't so great. I talked to her a little bit about assumptions. Hey, you've got an assumption, a great opportunity here. I think you'll get a lot of traffic from this if you market this as an assumption. And nothing. So, okay, great. Well, about 40 days goes by. And apparently they got no traffic on this house whatsoever. So she calls into our team line, and this happened all the time back then. Agents that were not interested in hearing about what they probably thought was the scam of a subject to or a wrap. And then all of a sudden they start calling back because their houses are sitting. So they had a little bit of motivation. I got to sell this house. So Twyla calls back, calls the team line, gets in touch with Rachel. Rachel talks her through it and says, yes, you have a phenomenal property here. Market it like this. It's very simple. Just put it on the MLS like this. Within 48 hours, they had 13 offers. And here's the reason why. If you look at the purchase price, $395,000 here. Look at the loan amount, $368,000. So that's $26,000 of down payment. So basically like 6%, 7%. It's like a 7% down payment. And the interest rate was 2.999%. So basically you have a sub 3 interest rate, no mortgage insurance on VA loans. So this actually had so many investors that were so interested in this because they put so little down and they get an interest rate of 2.99%. And if you look at the economics behind that, because we included this with when we sent this to Twyla saying, here, you want to show these economics also? $395,000 house, look at the difference in the payments with the same amount of money down. Regular financing at the time, $2,800. Assuming that loan, $1,800, $1,000 of savings a month on a house in the price range of like under $400,000. And that's the reason why they got so many offers, because she marketed it correctly as an assumable, showed the economics, and then it was actually investors that went crazy for that. Amberwood was all primary, and we had another one. I'll show you Chatsworth. Any questions on that so far? Entitlement, this piece, economics? Okay. So here's another one that I really like. This was one that was a little bit different. This is what the investor ended up telling me, that it was more of a cash on cash deal for him. So it was actually an agent investor. This is one of the things I find in the classes that I'll teach, is you'll have these agents, especially, that the first thing that starts going through their head is like, I can take advantage of these. Like, I'm an investor also. Like, I can buy more properties using this. So they start thinking like, not so much like, hey, I can go get more sellers and more buyers. They're like, oh my gosh, I can go out there and find these and then buy these. So this was the case with this one. We had an agent. He found this property and he's like, I'm an investor. I want to buy this. $500,000 purchase price, $464,000 current VA loan. Again, the seller willing to allow their entitlement to be encumbered. So that's a $36,000 down payment. So basically 7% down again. The rate was 3.75% on this. So the total payment for him, again, a savings of almost $1,000 versus regular conventional financing, which is why an investor wouldn't have purchased this unless it was under an assumption, because this isn't going to pencil out at all. This right here, he was cash flow positive by like $100 or $150. Nothing like that's nothing realistically in a Kiyosaki, rich dad, poor dad type of world of cash flow. But Amit, the investor, he's like, yeah, I purchased this because I've only put down $35,800. But there's the amortization side of things, which I'll go through, which means you're getting this loan
Di mo naman na ginagamit eh.
that's already paid 2 years of interest, because it's not a brand new 30-year loan, it's a 28-year loan, which means that seller has already paid 2 years of the interest, and mortgages are very much interest front loaded. So a lot of that was already paid. And I can show you an example of that too, actually. Let's go into that. So what I'll do is I'll go into, before we kind of wrap up like the first part here, because we are buzzing through this and I'll answer questions, is I want to go through and talk about some of again, entitlement a little bit more, blended rate, but then we'll go into questions and then we'll take a little bit of a break. So let's go into, can everybody see that?
Yes.
Okay.
Yes.
So let me go here. And then I'm going to go into some of the calculators that we have. So the amortization, because you heard me say that, so I might as well go ahead and explain kind of how this works. And I'll use another real life example. So there was a house, we call them by their street names. So it was Elgin, and Elgin had an original loan amount of $765,000. The rate was 2.875% on it, and it was taken out. Yep.
Can you make that bigger? I don't know if it's just me, but I can barely see it.
I can. Usually I just do this. Is that bigger now?
Nope.
Now it's too big.
Okay, so let me go here and then let me do the screen sharing thing. Stop share. And then I'll reshare. And we're gonna do. Tell me if that's better.
Yes.
Perfect. Okay. So you have, again, Elgin, original loan balance was 765,000. Loan rate was 2.875. It was taken out it was August of 21. And then add second loan to compare. The current balance, of course, I'm rounding. The current balance of that 765 at the time was 725,000. And it was the going rate at the time was 699. Always put 3 in there. Now, the sales price, and the reason why we always bring this up, because it was a financial advisor, had young kids, had purchased this house. The list price was 875, and he pushed it up. He bid it up to 925. So, of course, we're going to ask him, like, and it was on an assumption. So why did you pay $50,000 higher? You're a financial analyst, would love to get your input. So the first thing that most people look at is here's the monthly principal and interest payment on the assumable side, $3173.93, versus the payment on the brand new financing is $4818, right? So that's a savings of $1,700 a month. That's the first glaring easy thing that everybody can see of, wow, this is great because of that. But what he pointed out is he's like, take a look at the total interest that I have to pay on this loan. And he was in this thing for the long term. He's like, it was the school district he wanted to be in. He had young kids. He planned on basically raising his kids in this house. So he's like, I will end up paying $308,000 on this assumable loan. If I do a regular loan, I'm going to end up paying over $1 million. And so it was just that amortization side of things where I was like, wow, that is like super powerful. And then it's the reason why we kind of incorporated it into like how we present this. If you look at the monthly payment on the brand new loan, if they would have done just a regular, conventional financing, of that $4,800 payment, $595 goes towards principal, and the rest is interest. But again, since a lot of interest has already been paid up front on the assumable loan, the principal is not even $1,341, because remember, it's an existing loan and we're actually on payment 39 now. So of that $3,100, $1,400 of it is principal. So it's paying down the principal much more quickly. And that's the reason why when he went through the cost analysis with us, we're like, wow, that's super smart. So and that's one of the things when we talk about with agents, when agents tell us, oh, this assumption thing, it's only like a quarter of the market, and I have very picky buyers, and they're, they want the right countertops, and they want the, the perfect finishes and all that kind of stuff. But you don't understand my buyers, they're very picky. If you show them this and you say, well, listen, you can buy this house that doesn't have as good a countertops, or you can buy this house that has the right countertops, and this one's assumable, why don't you save the $700,000 in interest and just buy your own countertops, fix it up over a couple of years, whatever you want to do. So it's something where you can get past that, oh, well, I need the perfect everything. The other thing that I'll tell you, if you guys are on the buyer side, especially, is you have a lot of agents and a lot of buyers think of one thing when they think of assumptions. They think of lower payments. Oh my gosh, I can get this particular house and I'm going to have a lower payment because it's an assumption, right? So they're thinking, I was pre-qualified by, my lender for, $600,000. If I go find a $600,000 home, then here's my payment, regular financing. Here's my payment through an assumption if it's assumable, and wow, look at the savings. There's another whole side to this. When you have your buyers, and I run into a lot of them, if they're qualified for $600,000, a lot of times they're like, you know what? I can't find anything that I want to live in for, $600,000 house. Nothing in the school district that I want to be in is at $600,000. Well, you just change that mind frame or that mindset where you're not looking for a $600,000 house and maybe you get a lower payment. You're qualified for a specific payment. So let's say that payment is $3,000. Well, instead of finding a $600,000 house, you can find an $850,000 house because that payment is going to be the same. So now that buyer is able to move into that neighborhood that they want to, get that school district that they want to. And do you really think that they're going to care as much about, oh, it doesn't have the block fence I wanted, or it doesn't have the countertops I wanted? They're in the area and the neighborhood in that school district that they wanted to be for the payment that they could afford. So that's the other side of like how you view assumptions, is not necessarily just savings, but being able to like level up in an entire, like a whole different school district and house. An $850,000 house is going to be, and that's what we've seen, is it's usually about a $200,000 difference in home price for the payment. So if you can get that, when you start thinking about that for like buyers from your past that said, I just can't move because I can't afford to live where I want to live, that's where you can look for assumptions and get them into that house. Let's look at. So here's another one. So another tool that we have that it's super basic, but this is you'll get this objection from buyers all the time. So let's use the example of, let's use the $500,000 house. $500,000 house has a $400,000 assumable loan, and let's say it's at 3.125%. And your buyer doesn't have 100,000, he can't get 100,000, but he has 50,000, he can get that, buying it as a primary residence, but he has to get a second loan, the secondary financing of 50,000. It's below 100,000. Say his credit isn't perfect. So let's say he's at, I'm going to throw in even 11.5%. Let's throw that in there, right? Immediately, if you were to ever tell your buyer, oh, well, yeah, you can just get a second mortgage and it's 11.5%. No way. Like the buyer's like, I'm out, done. I can't afford 11.5% mortgage. I want nothing to do with it, period, done. Right? Well, you're like, whoa. So let's take a look at this. Let's do the math behind this. So blended rate, the thought process behind blended rate it's very simple. It's just your old high school weighted average, right? So what's the weighted average of the interest rates to the loans? So you calculate that. So you look at the blended rate there is 4%, 4.06%, even with that really high interest rate. So then the question becomes, do you want to go out into the regular market and get a 6% loan? Or would you rather have a 4% loan? And the benefit to this also is, let's say, for example, you pay this down over time. So you use your savings and say you pay $10,000 off the first year. What's your blended rate now? Oh, now you're at 3.89. And then you pay it down to $20,000. What's your blended rate? Until obviously when you pay it off, the blended rate becomes whatever the first mortgage is, 3 1/8, 3.125. But now let's go back to this example. And you have someone that says, whoa. Okay, what kind of loan is that second loan? And there are some fixed rates, but most people end up choosing a home equity line of credit, a HELOC. It's a purchase money HELOC. And they say, whoa, isn't a HELOC, can't the rate vary? It varies, right? It's tied to prime. And coincidentally, the Fed has lowered prime, and the plan is to lower it some more, which directly affects HELOCs, but not mortgage rates, but it does affect that HELOC rate. But let's say, for example, economy goes to hell in a handbasket and rates just soar. Does anybody know the max interest rate that a HELOC can go to, home equity line of credit? 18%. That's worst case scenario in case everything goes to hell in a handbasket. Your worst case scenario is 4.78%. Worst case, if everything goes wrong. And again, if you just pay that down, your blended rate is still well below market. That's how you answer that objection. And everything we've done on this website, and we've improved, like we've done so much over the past probably year and a half, as far as improving the website, the accuracy of the data, the tools that we put on here. but everything that we've done as an improvement based on your guys' input. So whenever we have like users, like agents that are like, you know what would be really cool is this or that or this, we always add it. So for example, this clients tab here, this used to be super basic. It's no longer super basic, but it started with an agent friend of ours. He came over, sitting in the office, and he's like, you know what would be awesome is like, we've got the website up, but I wish I just had a little spot that I could just put all my Assumable clients in. I just want to put in their contact info just so I have a little list of them. So we're like, okay. So a week later, we had it up and running. He could just add in his clients. Super easy. We had another agent that said, you know what's killing me is explaining VA entitlement. Okay, so this is where I'm going to go into this. This again, when you're on the buyer side, when you're on either side, actually, buyer or listing side, being able to understand and explain this to a veteran is super important. And again, that's another one of the reasons why we exist is basically to educate everybody. Like we're educating you. We do the same thing with buyers and sellers. So if you ever have a seller, a veteran seller that wants more information, you have enough info that you're armed with that you can get them to understand it mostly. But then if they want more granularity, of course, we are willing to talk to them and kind of educate them. So we created this calculator to help explain it or help calculate what a veteran's bonus entitlement versus regular entitlement is. So again, let's say I'm going to change this. This is the minimum conforming loan limit throughout the US is 766,550. But it's going up, and I think it's supposed to go up to 803, but I'm just going to use 800 as as a baseline for ease of math. So the way that you calculate bonus entitlement, and so let's say, for example, again, I'll use Sarah. Let's see, Sarah, your person is selling their house. They probably had an original loan amount, I'm guessing around 425-ish. Is that probably a good guess?
Correct, yeah.
Okay, so they have an original loan amount around 425. And if they allow a non-veteran, so they say, you know what, I'm going to open up my house to a broader buyer pool, which is going to be non-veterans and investors. So it just opens up that buyer pool, which, you know, hopefully would bring more buyers, higher price, whatever, selling a little bit more quickly. But your seller is going to be like, well, what does that mean? Can I not get another VA loan? Can I? Etc. I know that you said that in your case, they weren't planning on buying anything, but let's say that they were thinking about buying something. So let's calculate what their bonus entitlement is. So in this case, their bonus entitlement is $375,000. And what that is, it's simply whatever county they're buying in, it's the maximum conforming loan limit minus the original, not current balance, but the original balance of the loan that you're allowing to be assumed. So if the original loan amount was 425, you subtract that from 800 and you come up with 375,000. Now what that means is they can go out and buy another house using VA financing with zero down up to $375,000. But does that mean that that's as high as they can purchase? It doesn't. They can buy a house that's higher. Say they want to buy a $500,000 house. Or there's a $525,000 house they saw. Or it was a new build and they wanted to buy a potentially a $550,000 house. So what that means is if they go above their bonus entitlement, 55,000 should be 550,000. If they want to go above their bonus entitlement, they just have to come in with the VA guarantee portion, which is 25% of the difference between the purchase price and their bonus entitlement. Now, you guys don't need to remember all that. You just hit calculate basically. So what that means is if they're buying a $500,000 house, they have to come in with a $31,000 down payment. And who knows, they might actually have sold their house for $31,000 net more just by doing the assumption. But when we had one of the agents that we work with, Cody, his name's Cody Ramirez. And I don't know if anybody here was on at some of the classes last time we were out there. Cody was with us, but he now has, I think in the past 7 months, and he's one of the ones that's focused solely on assumptions and really grinded with it. But he's closed, it's like 24, 25 assumptions with another 20 under contract right now. But one of his struggles at the beginning was he said, these listing agents don't know anything about like VA entitlement. So I don't think that they're able to even explain that at all to their sellers. So he's like, can you create like a form that I can include with my offer, so it gets to the sellers so they become educated. So we did that. We just basically created it to where you could make a PDF out of this. And this is something that Cody started including with his offers. So he knew it was getting through to the seller. And it just goes over the very basics of VA entitlement. Then it goes through some potential scenarios for them going out and purchasing another house and what that would look like with down payments. But then I think the really important part here is basically, if you want to verify anything that we have on here, here's the number to VA directly. Call VA directly. And they're very good. VA is very, very good about answering their phone and giving help to all of the veterans and educating them. They're very, very good about it. But they will verify everything on here. So Cody started including that with a lot of his offers, and it started increasing his acceptance rate. All right, so let's get started. I'm going to go through just kind of some of the basics about our website and how it works. And then I'm going to move over to this screen and talk about Sarah's listing and how you kind of look at the economics behind it. And then what I want to do after that is then I'm going to go, Diana, I'm going to bring yours up and then we can look through that. And then probably answer any of the questions about as far as websites concerned, etc. So over here on the left side, this is our homepage for our website. It's takemylowrate.com. And effectively what we've done is we've created a mini MLS for assumptions. So all of the properties that you'll see on here, they're all going to be assumable. We're probably right around a, 95% accuracy rate. I did notice in one of the searches I did just right before I hopped on. I did like a $50,000 down, all interest rates below 4%, et cetera. And I found one that looks like it's either a short sale, but more likely it's a reverse mortgage, for example. So every once in a while, something like that is going to slip through there. But otherwise, you're going to see all of the properties on here. Now, on the left screen, this is where your just general public is coming to the site and they don't have like a login, they don't have or anything like that. So let's say they come to the site and they want to search Las Vegas properties. So they just click on Las Vegas. And when it comes to here, first thing you're going to see here is it says, hey, sign in. And if they're like, well, I don't have an account, so they need to create an account, or you can do the login with Google. But let's say they want to create an account. So who referred you? Oh, well, my real estate agent. No, let's just say, it was word of mouth. Someone said, hey, go look on this site for Assumable properties. And it is Joe Schmo. Joe Schmo hopped on there. His email is joesw@firemail.com. Phone number 602-316-8520. And he's a buyer. So this is what anybody coming to the site has to fill out just to start searching. That's it. And then they hit sign up. So what happens there is all of that, that's basically kind of an information grab for us, right? So it's an information grab, pretty much becomes a lead for someone searching for properties in Las Vegas, etc. And then we kind of we haven't really perfected all of our lead follow-up at this point because we've just been getting inundated. But what we also do is we just redistribute those out to, like, say, our certified agents, etc. You'll notice here, and again, this is general public website. So now someone that's just searching in Las Vegas, you're going to see on the right-hand side, every like 10 seconds or so, it's just going to scroll through all the different certified agents that we have. And that's the certified agents are ones that are subscribers. So they have a subscription to like the whole back end, and I'll show you guys that in a little bit. And they've passed our certification test, which is it's not super easy, right, Michael? Not super easy, but so that they've passed our certification test. Now, let's just say, for example, you have somebody that's on here, again, general public, that they just want to search for houses. It works pretty much like an MLS. So let's say, for example, they want to see all properties to a maximum I mean, I'm going to put 4% in here. You can type in whatever you want, 3.99%, not 43.99, 3.99%. You're going to apply that. And then let's say, for example, your max monthly payment, you want it to be $3,500 or less. And you are, let's say, for example, right here, it's without secondary financing or with secondary financing. So if you're doing primary, you can click this one, but let's say we're not doing primary. So someone says that I have $165,000. So they type that in there. So they apply that. So now it's going to filter out all the properties that don't fit that criteria. In fact, let's make this a little bit lower. So let's go 2,500 and apply that. I want to try and whittle these down. There are, like, I was looking through Vegas and there are like quite a few like really good deals out there. So let's make this even like 100. Let's make it 90,000. I want to really whittle this down. Apply. Okay. So now it's whittled down. So it looks like there's like 41 homes that fit your criteria. I want a max interest rate of 3.99%. I don't want a monthly payment higher than $2,500. That's principal and interest. And then I have $90,000 and that's it. And then you can do the whole bed, bath, and everything else that you want also. So when you look on here, all of these, I just call them white bubbles. Let's click on one of these properties. So see this white bubble here? This is like a 2.9% interest rate. I just randomly clicked on this. $415,000 sales price, $82,000 down. You're kind of like, oh, it's like 20% down, 2.9 rate. That seems interesting. Let's look at it. So you click on view property and you see, okay, well, PIT monthly 2009, interesting. So if I can rent this thing for more than that, it might be worth me getting. And so I want to inquire about this home. So someone hits inquire and then they put like it and then submit. And that literally comes, again, it comes to us with somebody that is like, I'm interested in this particular home. You'll also see that since it was a white bubble, and when I say white bubble, that means we haven't really certified the property. So for example, again, on Sarah's property over here, I'll be putting that it's verified because I got all the numbers directly from her, but it's not until I actually see a mortgage statement that I'm like, I am positive that it's exact, and then I certify it. So it'll become an orange bubble on the website, and then most of those don't last all that long because they usually get sold. But an orange certified property means that the seller and the listing agent, they understand assumptions, they understand their options, and they are on board with doing an assumption. The white bubbles, these are a lot of these people, they have no idea that it even is assumable. So for example, Edward Orossi, I mean, he might not even know what an assumption is, but he has a relatively decent assumable property here. And this is how the general public would be searching. Now, we have an entire different side like of our business. So our main business is we do the assumption processing. We help the buyers get pre-screened. Then they go out shopping for assumptions just like they would regular financing, et cetera. They have a pre-screened form. And then when they find an assumption, like let's say, for example, you had a buyer that was interested in this house. Then if you guys talked with Edward and he's like, okay, that sounds interesting, but I need to know more, then you could definitely connect them with us and we would educate them as far as like, how does the whole assumption world work? You'll also notice on here that it doesn't say if it's FHA or VA. Again, that's for the general public. When we first started, I'll go back here. When we first started this, we only had a couple filters, but then over a course of time, we've just improved and improved. But one of the things that we saw here is loan type. See where it says must be a subscriber to use this filter? What we ran into was we would say, okay, here you go. You guys would send them to our website and send your clients to our website, that they would go on there. And what would happen is if you had an aggressive, smart, savvy investor, a lot of them would just filter by VA, see the properties that were only VA, and then they would click on them, and then they would call the listing agent directly and just bypass you guys as buyer's agents. And that's not really what we're in it for. We're in it for, like, we've just been lenders for so long that we're so used to collaborating with agents that we want to help you guys generate more business. We don't want your guys to, bypass you guys as buyer's agents and go there. So, which actually brings up another one of the improvements that we did to the site, and it gets on the subscription side. But one of the agents we work with, Josh Zuniga, he said exactly this when we first just had our website. He's like, I have a huge social media following, and I can throw a ton of people at the website. He goes, the problem is I'm sending them, like if you see here, I'm sending them to my competition. And if a general public, someone goes on here and starts looking through all of these assumption specialists, you know, they're basically saying, I'm sending it to my competition and I can't track it. And I'm like, you know what? That's a really good concern. So we got with our, it was Josh, myself, and my developer. And what we did is we ended up creating, again, on the subscription side, every agent then has their own landing page. So their own landing page would look more like, say, for example, let's just go over here. Actually, you know what? I'll just take you to one of their landing pages. So it's www.azassumptions.com. So you'll notice here, this is Josh Zuniga's. It looks exactly like our page, has all the functionality of our page, and it also has all the lead generation of our page. So if you start sending your people to your landing page, if Michael sends them all to his landing page, just like Josh would send them to his landing page here, and they start looking at properties, it's going to send all the leads to them, and it auto-populates. If you look over on the right side now, see the clients thing? This used to be like super basic, just a list of some clients. Well, what this is now is this auto-populates a client into that landing page, and it keeps track of all of the activity that they do on your landing page. And again, since it's like a mini MLS, you're able to create search criteria for those for your buyers, whether if they have a buy box as an investor or they have a certain area, you can do like area searches, and it works just like the MLS. It'll send them out those listings, the new things that come up every day. So it'll send it out to your clients. Actually, one of the key things in here that a lot of the people that are interested in the assumption side of things is, and I'll go to Nevada here. This is the newest listings. This updates every 10 minutes. So it shows you all the latest assumptions that pop on the market. And so this is whenever I say a good assumption, it's ones that are usually with a low delta and a low interest rate. When they pop on the market, they are very competitive. They get bought in hours, if not a couple of days. So this is just something that keeps you like with your finger on the pulse of the market is, I guess, the best way to put it. So that's the latest listings. At any time that a Assumable listing comes on your MLS, it populates here.
Hey, Mike, it's Michael Goff here. I have a listing as well that's probably Assumable. It's a VA loan with 2.75. Can we see if it's on there?
Sure. Let's, what's the address?
8040 Mercury Sky.
8040 Mercury Sky right there. So yeah, so now again, if I'm searching, now I'm on someone's their landing page, which is Josh Zuniga's landing page or his, I'm able to get more functionality here. But if you look at this one here, I have the assumed rate at 3.31, which is an estimate based on the day and the year that they took out that loan. But if you're saying it's a 2.something%, what you would do is you just shoot me over the mortgage statement for this. And then I can at that point just certify it and get it up as a certified property.
Okay, thank you.
Okay. Yeah, that's pretty good. Okay, so now I want to hop back over here. Now I'm signed in. So again, this is on the subscription side. When any of you guys, if you go onto the subscription side of things, not just searching for properties on the general public site, but you have your own site or you subscribe for all the different tools. Some of the great tools on here is which you don't see on the left side, but you see on the right side because I'm signed in. Over here, there is no sign in. This is just a regular person searching. See on Sarah's house right here, if I saw, okay, 525, $112,000 down, what does that look like economically speaking? Well, we created a one-touch button here that's create a loan comparison. So it pulls in all of the public data information, and then it populates 3 different options. Sometimes it's only 2 options because maybe the delta is less than 10%, but here the delta is more than 10%. So you can very quickly see what the economics look like behind this property. So let's say, for example, you assume the loan and you come in with the full delta, $112,000. You're looking at a total monthly payment of about $2,360. I think Sarah said it was like 24 is what they have. Now we estimate, remember PITI, so we know the principal, interest, taxes portion of it, but the insurance portion is something that I have to just basically, I basically put an algorithm in based on the area and the on the sales price, but insurance always varies by person. So this number never is going to be exact. So if they were to put the $112,000 down, their monthly payment's going to be $2,360. If they were to do a first and a second as a primary residence, putting down 10%, payments like right around $2,914. But if they did 10% down on just a regular, say, conventional loan, say for, I don't know, say this is probably closer to an investor right now, with 10%, you couldn't even do 10% down as an investor. But even if you could, it's a $3,600 payment. So you can see, even like for like on down payment, you're saving $600, almost $700 in payment on that. And then let's say, for example, you're here and you see, oh, well, 6.82, which is the average, but you know, everybody's paying a point or a 1.5 in today's market. So it wouldn't be 6.82. So you're like, I want to edit that. And so let's say it's like 5.99. So then it's just going to recalculate that for you. And let's say if you're on the listing side, so in this case, Sarah, if you said, oh, you know what, I want to put this in my documents in the MLS, you would just download the PDF here. And then it's actually branded. Here it's branded to me, but it's branded towards the subscriber. But this is something, again, another tool that you can use to exemplify is not the word, but exhibit the benefits of going with the assumption for someone looking to purchase the house. So let's go back over. And then it also has another one touch for create the amortization sheet here. But I look at this right here, and if I looked at this from, you know, if you're a primary residence buyer, and Sarah's already said that her buyer is okay with giving up his VA entitlement, because remember, like when a non-veteran or investor, even if it's a veteran, if they purchase it or if they're assuming the loan as an investment property, there's no swap of entitlement, which means you can't. That entitlement's going to remain encumbered regardless of whether a veteran takes it over or not. If another veteran comes in and says, I'm going to buy this, I want to assume your loan, I've got the $112,000 down, I'm going to assume your loan and I'm a veteran, they can do what's called a swap of entitlement. So the incoming buyer, primary residence veteran, can take over that loan, assume that loan, and have it go onto his entitlement. And then the original entitlement is released back to the seller. So he then has his full entitlement left. So that is possible, veteran to veteran, primary residence. It is never possible with a non-veteran because there is no entitlement for a non-veteran. And it is also not possible as an investment property.
May I ask a quick question?
Yes, absolutely.
Would it be better if the deal that we have in place does not end up working out to put it back onto the market as a brand new listing and market it more heavily towards being assumable, or just leave it on the market and just flip the switch to have it be assumable? Does that make sense?
I don't know the answer to that, of whether like the days on market type of thing, that might be maybe a better question for Michael, but from an advertising perspective, putting it out there is like very simply put, like literally the verbiage is super simple. Here, let me see if I can.
So while you're looking it up, Michael, you are correct. It would show days on market in our MLS. So even if you took it off and waited a week or so, put it back on, it's going to show cumulative days on the market, which would show the person no matter what. So it all depends on your strategy on how you want to market, because you say, well, it'd still be fresh in the sense of it's been off for a week, comes back on, it'll show up as a new listing in the sense of the hot sheet and stuff like that. But it's going to show the yeah, total days on market on the MLS if someone is paying attention.
Yeah, and I don't mind that as much because I can talk through why it's been on the market and what's happened to, to outweigh that. So, but I want it to more so perhaps be fresh and pop up and okay. But thank you.
Sure.
But honestly, the way I would do it, and this is my personal opinion on it, I would do out a fast flyer as a brand, touting the VA benefit of assuming it. It can be done by an investor or whatever, and even do an open house with that to get the people in where you can talk to them. Because Mike explained it's a lack of knowledge. People don't understand it. I myself, I'm a veteran, and he helped me out understand about the encumbrance on the entitlement, which again, and I don't think you went into it, Michael, after a break, but there is some of them have bonuses, and also they, if you bought the house 4 or 5 years ago, you have a lot of space on your entitlement to go buy another house. And what the veteran is normally fearful of is that if something happens to the house, they're going to be responsible. That's actually the more fear. They think entitlement means that they also are responsible because that's the way we're trained in the military to think. So you need to kind of uneducate them and re-educate them in the fact, your sellers, that they can give up their entitlement of that amount. They still can go buy another house. It's still allowed. They only can utilize a certain leftover remainder of their entitlement, but most of the time that's enough to buy another house. You might not be able to go buy 2 or 3, but you could buy one other one and have that one as still encumbersome you. I didn't use the right words, but I think you know what I mean.
Yes.
And correct me if I'm wrong, Michael.
No, that was right. So I've got another, can you guys see the Word documents I have up there?
Out of timing.
Yes, if I have a magnifying glass.
Okay. Let me
Remember, I'm 65, not your age, my friend. So
let me see if I can, how about here? Can you see this on the right-hand side where it says listing?
We can see it. It's still really small.
Okay. Well, okay. So I'm just going to go real quick on this. So this is literally down here. This is where the big VA. I know the rest of this is super small. This is normally how we have like the very simple verbiage that you put up on the MLS, and you do it in the public remarks. So it syndicates out to like Zillow and everywhere. Literally, it just says assumable VA, all caps, assumable VA loan at 2.625%. Yours in this case is it actually 2.625? That's coincidental. Exclamation, exclamation, open to veterans, non-veterans, and then in all caps, and investors, exclamation. Must be pre-screened through me assumption specialists, because you want to make sure that you have a qualified buyer. Because remember, the whole pre-qualification letter on new financing doesn't work. And then this is an important part. So escrow opened with, this is our Phoenix side right here, but on the Vegas side, let me get rid of that. The Vegas side, you want, so as lenders, like, growing up in the industry and as lenders, we never really have cared too much about the title company, I guess is the best way to put it. When we're doing new financing, it's like, because the agents always figure out whoever they want to use for title, etc. Once we got into the assumption side of things, that all changed, because we were still of the mentality when we first started, like, oh yeah, okay, what title company are you using? And then you have these title companies, and so many don't have any idea how to do assumptions. And then we would run into some that are like, oh yeah, we've got one, we've done a few of them, blah, blah, blah. Well, Chicago, what they've done is they created an assumption department for us, basically an entire assumption team that their focus is on assumptions. Because if you don't really understand the inner workings of how each of these individual services processes work, because there is no standard process in assumption. There isn't. All these different services have all these different, like Mr. Cooper is different than PennyMac, different than Lakeview, different than Huntington. And if you ever run across Huntington, run, they are awful. Different than Carrington, etc. They're all different. And if you have an escrow officer that doesn't really understand that, it is going to make for a horrific, or could potentially, and has a potential horrific client experience at the end. And one of the examples that I'll use, where I had an agent, and this is probably like 6 months ago, they're like, my girl says she knows how to do these, blah, blah, blah. I definitely want to use them. I'm like, okay, we don't mandate anything, but we highly suggest. Well, 3 days before closing, 3 days before closing. And it was like 95 days into it. And we finally got everything done, clear to close, all that stuff with the servicer. 3 days before closing, the escrow officer wanted to make sure she had all her I's dotted and T's crossed. And she sent in for a payoff request to PennyMac. And can anybody guess what that did? Escrow officer sent in a payoff. So what that does is PennyMac, remember, they don't hire the best and brightest. The first thing that the guy says, the processor at PennyMac, is, I thought we were doing an assumption, right? In the new financing world, refinances or purchases, you do order payoffs and you do want to get your numbers accurate. In the assumption world, it doesn't work like that. Well, this escrow officer made a very small mistake, 3-week delay. We closed 3 weeks after that 3 days. All because of a very, very, very minor mistake in the new financing world, because it's an easy phone call of like, oops, sorry, didn't mean to do that. But when you give these servicers a reason to delay it or to deny it, they take it almost every time. So all we're saying is very highly suggest that for your assumptions, especially assumptions, that you're using like Chicago tech, not just anybody at Chicago, but it has to be like the Chicago team, because they're not all trained for assumptions, but the Chicago team. So that's what this says in the, again, you would put in the listing that escrow opened with, and then it gives, in this case, it's Chelsea. But you would coordinate that with Misty.
Yeah, that's on Misty Tiffany's team, right?
Yeah, so that's who is there. I'm much more familiar right now with everybody here in Phoenix, that whole team. And then we have the team from here that trains the team in Vegas and in Colorado and California and all over. But so it's just important that you look at that. But that's something that you would want to put on your listings.
The chat box, if you guys want to, it's title assumption team at ctt.com. So that's the assumption team email with the escrow officers on it as well for future questions. Thanks.
Okay. So Sarah, do you have any other, or anybody have any other questions on Sarah's particular scenario? Because what I want to do is, here's a question. Oh, all right. Here's one, since I just happened to see this. So Sarah, tell me about the solar panels on here.
The thorn in my side.
It always is. It always is.
I mean, the financings with GoodLeap, who I have worked with before, we do prefer to have the solar panels assumed by the new buyer. The caveat is that the balance is larger at 50,000. Payment is $241 per month. If we could get the price of the house up a little bit, we would rather pay off the solar panels. That would just make it a lot cleaner. And so, but that's where we're at right now.
Okay. So solar panels are the bane of the selling process here. And then I don't know if GoodLeap, I think it is GoodLeap. One thing in particular, like if you get any questions about this, if an investor is going to come in, I believe GoodLeap, you'll definitely want to look at your solar, the documents there. It's like on page 1, it'll say primary residence only. So you cannot be an investor. But then if you dig deep into their guidelines, like into their actual guidelines, it says owner occupied. Have you run into that yet?
I've had investors that have been interested, and I have maybe fallen into that trap because it did say on the first page that no, and it had to be a primary. And so I didn't dig deeper than that to find something else to contradict that.
Okay, so here's an example of like when we've come in and we've kind of like, I would say the value to what we do is when we have the buyers and we're doing the pre-screening and I just happen to see solar panels, and if it was GoodLeap and coincidentally it is, I promise that Sarah's not a plant. It's just coincidental. So GoodLeap in particular, on the front page, it says primary residence only, you can't be investors. But then if you go deeper into their guidelines, it says must be owner occupied. Well, when you're assuming a loan, a VA loan, they don't care if it's primary, investor, or second home, right? They don't care how you label it. You're able to assume that. So the workaround that we had for that was we actually had the investor assume it as a second home because he was doing short-term rental. So technically you can call it a second home if it's a short-term rental because you don't have a year-long lease on it. And so you're not, again, you're able to because the second home is all, I guess the technical definition is you have to be able to live in it. Or not be able to live in it. You're able to vacation in it or go to it. So there's not a year-long lease within a year. So if you do second home, it's technically owner occupied. So that's how you get around the good leap thing. So that's just one thing. Like, again, one of the small intricacies or granularity within an assumption that's super complicated that you've just got to know in order to get those types of things done. So solar. So whenever you see solar, just remember that raises a little bit of a red flag of like, okay, let's make sure that we're going to get this put together correctly. All right, so let's look at Diana. You still on here?
Yes, I am.
All right, your turn.
Well, I don't want to make everybody go through it. If you if you want to do it offline, I can do that too.
No, I always think it's, I mean, if anybody, I always think it's a good example to go through real life examples versus hypotheticals.
Oh, perfect then.
So, okay, so first thing I see, and again, this is me just kind of looking at this. Okay, how good of an assumption is this? You're like a little over 20% down. Is this a condo or is it a townhouse?
I think they're marking it as a condo. It was a townhome when she bought it, and then they switched it, I think, to condos.
Okay, so here's a phenomenal thing about assumptions and, for example, condos. So condos in particular, let's say, for example, this was non-warrantable or it was warrantable when it was purchased, but it's non-warrantable now. When you're doing an assumption, there's no appraisal. So the whole warrantability thing is out the window. You don't need to worry about that. So
even if they're getting their second, I thought you said if they're getting that second loan, then they would have to have one.
If they are getting a second loan, then
Okay.
yes, it's up to the guidelines of that secondary financing.
Okay.
To where they may require an appraisal. Most of the time they do, but they
Okay.
may require an appraisal. But if you're not getting secondary financing, the first mortgage being assumed, in this case, yours is like 270,000-ish. They don't care about the warrantability of this place because the loan already exists on it. So you don't have to worry about this place being warrantable or not.
Okay.
And it looks like, so it's an FHA loan. So another thing that you look into, do you know, so Diana, what is the interest rate on that?
2.75.
Okay, so it's 2.75. So if the effective interest rate, just so you guys look at this, so the effective interest rate on this place, and especially since it's FHA, it's fantastic that you wouldn't need an appraisal because there are so few FHA approved condos these days. Warrantability is different. Warrantability really comes down to Fannie Mae and Freddie Mac, but FHA has a specific list of like, we will finance on these properties, all others we will not. So this would be a huge selling point for somebody that really wants this place, but can't really get the financing that they want. And assuming this, because you don't need it, you don't need an appraisal, and your interest rate at 2.875, effective interest rate on that would actually be like 3.7 because
Awesome.
it has 0.85% in interest in mortgage insurance, and that's for life of loan that you currently have on your current loan. And remember, you are assuming that loan from where it is now and all the terms with it, which, by the way, when you assume a loan and you're assuming all the terms of that loan, you're also assuming the assumability of that loan. So let's say you come in, you assume a mortgage, and then 3 years down the road, you want to sell it. Maybe you improved it, make a little bit extra money. Flippers maybe kind of fit in there, but you just want to sell it down the road. You can then also sell it as an assumable loan. So then they can assume that loan from you. You assumed the loan from somebody, and then they just assumed it from you, and they assume all the terms of it, including the assumability. So another selling point if you're on the listing side, and actually if you're on the buying side, because you can plan like, hey, if I want to sell this, if there's not a whole lot of equity here, or let's say, for example, you got into a property with very little money down, and then let's say, for example, property values drop, and maybe you're close to upside down. And this is something that we've seen a little bit of. You can do it as an assumable loan because we see a lot of people that are willing to pay a little bit more. Like Sarah, you were talking about, hey, if we could get a little bit more for this house, then maybe we could pay off that solar. There's probably a really good chance that a buyer would say, okay, great. Instead of if the value of this house was it 525 or 525? maybe I pay 535 or whatever that is because I see value in that loan there. And then let's pay off that solar so we don't have to worry about it. So it gives you guys a lot of flexibility, both on the buying and the selling side. And then let's take a look at this one too. And let's say, for example, let's just create a loan comparison real quick because it's super easy. I have someone that's interested in this property, and I know that the additional financing, honestly, it might be a little bit tough as a condo. Actually, my condo would be fine with this one. So let's look at the economics behind this. I'm going to put this into a PDF so it's easier to see. Oh, that's StarPoint. Sorry, I forgot to download it. So now I'm going to download this one. So let's take a look at this. So again, $347,000 sales price. There's a $275,000 loan on this. And so let's say you're putting 10% down effectively. Just by doing the assumption and getting secondary financing, you're saving like $330 a month.
Yeah.
Which is great at that price range. I mean, that's a great savings at that price range.
Huge, yeah.
And then if you can pay the entire, the 72,000, I mean, still great. 1843 as a payment. It's a big advantage, like as far as like interest rates are concerned.
Hey, Mike, can we see the loan details for my Mercury Sky when you finish with this one?
Yeah, absolutely. So okay, in going through this, I'm going to jump back over to Sarah's real quick so you guys will understand. So 73, that's Decatur. Let me get out of that real quick. This is start points. Okay.
Sorry, what was the question?
So Sarah, this is one thing that a question that I get every once in a while. You mentioned that their current loan amount is $440,000, correct?
Correct. So now because now they've got like fees that are coming in for like, just all of that. I'll get an updated one, but it's right around the 440.
Okay. So you'll see that with this 412 here, this is the loan balance based on normal amortization. So that's what it should be. Whatever the principal balance on the loan is what can be assumed. You cannot assume late payments and fees, etc. So in your case, there's about $30,000 worth of fees, etc., that need to be paid either prior to close. Now, there's solutions for that because many times the buyers don't have it. But a lot of times what we're seeing is once we have like final approval from the servicer, the buyer will come in with that and pay it current. So it's current to the principal balance and then assume that balance. So when you see that the 525 to 412, that's where they have to come in with 112,000. That includes that 40,000 because again, this would normally be 440 something thousand if you were including all those late fees, etc. But you cannot assume late fees and all of that. You can only assume the principal balance. So it'll be brought current. And we see it happen all the time. All right, so let's get out of that and let's go back into. All right, so we'll go to Mike's real quick here. And let's do this. 8040. This is my admin side that you're seeing here. This is where I can make all the changes to what it actually displays on the on the website. So Mike, you said what's the interest rate?
2.75. I texted my clients to see if they can provide me a statement or something showing that, but that's what the number they've provided me.
Okay, so 2.75. I'm just going to put that on there for now. It looks like, did they do down payment assistance when they bought it?
I don't believe so. No, they used the builder's lender, and I think they put a little bit of money down, so of their own.
Okay. Because it looked like there's like a second loan on there. That's
It
irrelevant for the.
They might have a HELOC.
Okay, so it might just be a HELOC. That's irrelevant from the assumption side because some people ask me, they say, okay, so my seller has their first, but then they also have a HELOC on it. What do we do with that? It doesn't, you can't assume the HELOC, and it works the same as though like if you're just doing a regular sale, that just gets paid off with the proceeds, plain and simple. Okay, so I'm just going to update the interest rate. Okay. And now I'll go back to here and see it says 3.31. Let's refresh it. 2.75. Okay, so this is gonna be a little bit more accurate. Okay, so what we're looking at here. So 2.75, and it's a VA loan. So then the first question that you're gonna have in this scenario is, are they willing to allow their entitlement to be encumbered or not? So that's a question.
Yeah, they're military, they're gonna PCS and they're gonna rent for 2 years.
Okay, so they're going to rent for, so they're gonna sell their house and then rent for 2 years.
Correct.
So, and I didn't hear the first part. Are they willing to allow a non-veteran to assume the loan?
I don't think they'll have any problem as long as it gets sold.
Oh, you don't, okay, so you don't think they'll have any problems getting it sold?
To a non-veteran.
Okay, so if they're gonna sell it to a non-veteran, oh, you're talking about regular market?
Yeah, we haven't had any showings on it, so I'm gonna really try to heavily focus on assumptions for a little while and see if we can get more leads and buyers on it. Actually, I think you mentioned Joshua, or somebody had on his website. Actually, I think he's one of the people that reached out to me about it. But that's all we've had is assumption questions on it so far, but no showings.
Gotcha. Okay. So if you did let's do a quick loan comparison on here, right? And we'll compare it to regular market rate. And so let's see, it says 6.82, probably more accurately, people are paying a point. So let's say it's like 6.25 is probably a little bit more accurate, I'd say. So then this is the loan comparison that you would use here. But I'm gonna throw a little but out there once I get the PDF up here so you can see it a little bit better. If you see here, $542,000 sales price, $413 loan amount. Wow, so they've had this for like 4.4 years. So the great thing about that is there's a lot of interest that's been paid on that. So there's a lot of interest that's been paid on that loan already. So that'll be super appealing from an amortization perspective. And that's something that most people won't think of. So if you're on the listing side and you have someone that's somewhat interested, then you might want to even mention, I would definitely mention that. It's you're getting a 25-year loan, not a 30-year loan for this payment, is really what's happening there. Now, if you compare the payments wise, if you were in the regular market putting 10% down, you're looking at like a $3,600 payment, same amount of money down, $3,000 payment. So you're getting like saving $600 a month with the same down payment. And if you can come in with the full amount, like that was like, again, an investor would probably be here. This is what you would then do more of a rent comp analysis to say, here's what the payment is versus what the rental analysis is. But so I want to go back to the entitlement piece. So if you have a non-veteran that comes to buy the house and they encumber the entitlement, the original, let's take a look here. The original loan amount, am I here? No, let's get there. 8040 Mercury. The original loan amount was $438,000 right here, right? So that's you're going to have that much of their entitlement encumbered. So let's use one of the calculators. Let's find a calculator. So calculator, VA entitlement. Again, this is going to be 800 just current, but let's say $438,000. That's how much of their entitlement is going to be encumbered if they allow a non-veteran to take over the loan, right? So they have $362,000 of bonus entitlement left. Now that's if they're purchasing, say, in Vegas or like Phoenix, but if they were going to purchase in, say, LA County, for example.
North Dakota is actually where they're heading, so I don't know.
That's going to be, that'll be 800. That's because that's going to be that's not a high cost area. So that's going to be, the minimum is going to be 800. So they're probably looking at 800. If they buy 2 years from now, it might go up more, but as of like in January, it'll be like 800. So that means, and I bet their housing prices are pretty slow in not slow, but lower in North Dakota. So if you talk to your sellers and say, hey, let's try and figure out what are your future plans? And they're like, oh yeah, we're going to rent for a couple of years, then we're going to buy a house. Well, how much is that house going to be? Oh, well, there are about $450,000 in the area that we're looking at. There's one at 500,000. And then, who knows, maybe there was one that was 400,000 that I really liked in North Dakota. And so you would say, okay, well, this is what you're looking at. If you allow a non-veteran to purchase your home, you're getting X amount more for allowing someone to encumber your loan. And the only way that you can actually measure that is the market will tell you. You'll have people that'll come in and say, hey, if I'm just going to buy this house and I'm going to buy it with normal new financing, and I'm going to give you $530,000 and I want 2% towards concessions. Or you might have someone that comes in and says, I'll give you $542,000, I'll give you full price and I want no concessions, right? So you just basically use that data to weigh out the numbers and say it comes to like $25,000. You're getting $25,000 more for your house by allowing someone to encumber it. And this is what it looks like when you're going to go buy a house in North Dakota. If you buy a $450,000 house, you can still do it using VA financing, but you got to come in with $22,000. You can buy a $500,000 house, but you got to come in with $34,000. And if you said that there was that one house that was $400,000, realistically, you got about 10 grand down and you get into that house. So is it worth it to you, talking to the seller, to take X amount more or to get this thing sold more quickly and allow someone to encumber your entitlement?
Yeah, they want it sold. They don't want, they're going to need to start renting in January. So we've got a little bit of time, but they don't want 2 payments. So they want it sold.
Okay, so they want it sold. Now to go again, these are because we've done so many of these and it's so fun. Every time I talk about secondary financing, we have like 80 of these in process right now. And I think we have 3 with secondary financing. Like I said earlier, people find the money. It's crazy. They find lots of money in this market. So I lost my train of thought there where I was going to go with that for you guys for the secondary financing. Oh, so you said that they want to get it sold. One of the things that I've also seen again in this market is when someone wants to purchase the house and they don't want to have 2 payments, but it's a longer process to actually process it. Say it goes like 60, so say it goes 90 days and some, like if there's some, depending on who the servicer is, it might go more. And we actually have, just to kind of go to that. So turn times. So here's the turn times that we've noticed with different servicers, what they will truly tell somebody outside of the public. They say it's 45 days because by law, it's supposed to be 45 days. So they'll always just say 45 days. But this is internally what they say versus our most recent closing with them. So this, when you know who the servicer is, you can kind of get a decent gauge on how long it's really going to take. But a lot of times you'll find if it's a great assumption, you'll have the buyer will say, okay, well, after 60 days, I'll allow you to take from my earnest money, the mortgage payment until the thing closes. And if the seller ends up canceling, then for some reason the seller cancels, then they owe the buyer back all that money. But if the buyer cancels, that earnest money is just considered hard and gone. So there's a lot of flexibility and there's a lot of like ways to solve problems in the assumption world.
Mike.
Yes.
My question is, because we're talking here on the entitlement. If a VA, I'm a veteran, if I'm an investor buying the VA properties, assuming them,
yeah,
does that hurt my entitlement or encumbers their entitlements if I wanted to buy an owner occupied?
It encumbers if you're a veteran and you go and buy and assume someone's loan as an investment property, you cannot swap entitlement. So it leaves theirs encumbered and yours isn't affected.
Okay, but it would encumber theirs, so I'd have to make sure that's understood.
Yes.
That they would be encumbered even though I'm a veteran.
Yes. Especially if you're on the listing side, especially, it's one of the things to look out for is if a veteran comes in and they say, I'm a veteran and I'm going to assume your loan, and you think, oh my gosh, this is gold. You got to make sure that they're doing it as a primary residence or they cannot swap entitlement. It'll remain encumbered in your veteran's name.
But a person can own, because I actually know a couple of investors that have like 5 or 6 VA they assume the loans as an investor renting out the properties. So
Yep.
there's no limit on how many I can have as long as I'm cash flowing and I not qualify. What do you call it? I'm okay. Whatever the word. What's the word you use when you
Pre-screen.
qualify someone? You don't say
Pre-screened.
pre-screening.
So
Is there in your pre-screening if someone has say 3 VA loan assumables they've assumed and they're a non-veteran? That's my question.
okay, so if they're non-veteran, so non-veteran assuming loans. So in the regular investor world, let's say you're going out and you're buying properties and you're just using regular, investment financing, whether it's Fannie Mae, Freddie Mac, they have basically a 10 property rule. So you'll have investors that if you have your larger investors, they will run into that where they're like, okay, I already have 10 financed properties. I can't buy any more using regular financing. That's not a rule in the assumption world. You can get as many as you possibly want. That's why I said you have a lot of these larger investors that are like, I want to do 20, 30, 40, 50 homes. If you're on the buying side, one of the reasons why it's so important to get your buyers pre-screened before you're even out shopping for assumptions is because, I mean, there's hundreds of differences, but here's a very key one. Let's say, for example, and this is the same for primary residence buyers as it is for investment buyers, but it usually affects the investors a little bit more. A lot of times you'll have that investor that, you'll talk to them and they're like, hey, yeah, I'm pre-qualified with my lender. I can buy 6 more properties. I can get a $10 million worth of stuff. I make $1 million a year or whatever the amount is. And I've got so much in the bank, blah, blah, blah. Right. And they're like, let's not do this pre-screening thing until I'm under contract. I'm super busy. I can't do it. They're your nightmare. And the reason that they're your nightmare is you will get them under contract. And then they're like, okay, let me just do this formality of a pre-screening. They come to us, they fill out the loan application, and it works. The process is the same as new financing, meaning like they go online, they fill out the stuff, they put in their income documentation. And what we do is we actually just re-underwrite them. We underwrite them to new financing guidelines in case they're going to do new financing, but we re-underwrite them to assumption guidelines. So one of the key differences for specifically investors is, to go back to Michael's point, is someone has like 4 properties. Any properties that they have not had, and when I say that they have not reported on their taxes for 2 full years, not 363 days one year and 365 the next, 365 days and 365 days. If they don't have those 2 years of taxes, they cannot use their income from that property to offset the payments. And so what that means is if you have somebody that just bought 4 properties, they have to then qualify from a debt to income ratio perspective with not only the property that they're purchasing, because you cannot use the expected rents on the property that you're purchasing to offset the payment like you can in new financing. In the assumption world, you cannot. And then you cannot use any of the rental income from the properties that you've gotten within the last couple of years. So all of a sudden you go from you're super highly qualified on the new financing side to you are denied in the assumption world, because all of a sudden you have $20,000 worth of monthly debt that you have to cover with your income, and it doesn't do it. So it's very important to get pre-screened ahead of time to know. And when I say the way that we do pre-screens and the way that you shop for an assumable mortgage is you don't shop for, hey, you're qualified for a $700,000 loan. That's new financing. In the assumption world, you shop by how much monthly debt can you take on and how much money do you have to put down. So one of our larger investors, for example, he has millions in like cash. So that's not really an issue, but he can take on $80,000 in monthly debt. So he can break it up however he wants. He can say, in his plan, what he told us was, I want to have an average of a $2,000 payment. I want to get 40 houses with an average of a $2,000 payment. He can break that up into 10 properties with an $8,000 payment. But it all comes down to that debt to income ratio and then the monthly debt that they can support, because that's how the assumption world works. New financing is always based off of like, hey, you're qualified for 700,000 because it's based off of today's current rates. But in the assumption world, all the properties have different interest rates and different payments. Long-winded answer to your question, huh, Michael?
Yes, but it was very good because I have a feeling that's, again, through this presentation, a lot of realtors don't understand. They're not loan officers like you and I are, that understand about the debt to come in ratio, about, the 10, probably a lot of them don't even know the 10 rule on Fannie and Freddie.
Yeah,
You
as
know,
an investor.
there are other banks out there that make it more difficult. I think US Bank only allows you to have like 5 non-owner occupied loans.
They do. Yeah, that's an
So
overlay, but yeah, so there's
yeah,
some that do that. So another a key piece for you guys, again, if you're moving through the assumption market, is if you do have somebody that wants to buy properties and they do say, hey, I'm going to look at both. I've got maybe some I want to buy with the new financing and some I want to buy on the assumption side. Always make sure that they do the assumption ones first, because when you do assumptions, you can't use any income from any properties that you've just purchased. In the new financing world, you can. So if you just bought 2 properties and then you're going to go buy another one on the new financing side, you just provide lease agreements for those properties that you just purchased, and then you can still qualify for the new purchase. You can't do it vice versa on the assumption side. So the strategy is always going to be do the assumption properties first and then move on to your limit of 10 and then new financing side of things. All right, so let's take a look at maybe just a random property out here. I think we've gone through most of those. And then actually, Mike, we went through yours. So let's, you know what? Because Mike, when I did see your create loan comparison, I'm going to be interested to take a look at this amortization side of things, because it did say it was like a 4-year-old loan. So let's take a look. I just did a quick one touch on the amortization side. So yeah, the difference here in the total interest left to be paid. It's like a $400,000 difference. And let's look at those payments. So of that, the payments, like here, look at this. Principal on a new financing, $351 of the $2,700 payment is principal. But on your assumed loan, I mean, we're on payment 53. Look at that, $884 of the $1,700 payment is going towards principal. That's something that a savvy buyer is going to look at, because that's a big deal, especially when if someone's concentrating on cash flow, because that's effectively cash flow, because that's paying down your principal. So that's something that you'd want to take a look at also. But I think I've gone through. What other questions do you guys have? I go from I think I've gone through just about all the main points that I wanted to hit. I guess, okay, so let's look at, the one other thing. So I keep talking about like the general website versus like the subscription side of things. So from a subscription side of things, let's see, where do I find that? I'm already logged in. Let's go over here, incognito. Let me open up another incognito. So let's go. So realtors. And again, this is non-logged in. This goes through all the tools and everything that we have. Now, there's two separate subscriptions. If you're like an individual agent, the Hertz plan is if you have a team or you have a brokerage underneath you, because then you can create a main landing page for your brokerage or your team where you can get leads and redistribute them out to your team or your brokerage. You can also have your agents sign up at a reduced price under you in the Hertz plan. But as an individual agent, the Jax plan, it's just $19.99. It's $20 a month, and that gets all the tools that I just went through. All the tools minus the only difference is in Jill's plan. That's where you get your own landing page. You can send people to your own website, which is basically all the functionality of our website, but it's all branded towards you. None of your competition shows up on there. And then you generate leads with that, and then that's where you're able to kind of generate more buyers and sellers, etc. And that's the Jill's plan. So from a cost perspective, now Misty also has a coupon code. So if you guys are interested, definitely let her know, hey, can I get that coupon code from you? It's 25% off. So either of these. So this ends up being, what is that, 25% off? It's like $15 a month or something like that, just to get all of those tools that we went through, the advanced search functions, etc. So what questions do you guys have? I think I might start asking you guys some questions. But what other questions or comments do you guys have?
When you mentioned the pre-screening for buyers that are potentially interested to qualify for the Assumable, I saw another webinar by another company where off the top of my head, they charged around $1,500 to go through the pre-qualifying screening that they provide, and I think they say $75 of it is due up front. I'm wondering how you kind of charge the buyer in order to be pre-screened in order to see if they qualify for the Assumable, or how you guys handle it.
Yeah, so for example, Assumption Solutions, I'm assuming that's what it is. They have a totally different what am I looking for? They have a different like business model, right? They're more of a DIY where they kind of like point buyers in the right direction. Or a lot of our, I haven't found anybody else that does that what we do, because we do all of it. Meaning like we do the pre-screening, we do everything. And for pre-screening and helping getting properties certified and all that kind of stuff, we don't charge anybody, because we still have that kind of like help the agents lender mentality, right? Of we're not going to get paid unless we do something, unless we complete the transaction, unless we're done with it. I don't want to charge anybody $75 to tell them, oh no, you're not qualified. Or I don't want to charge them $1,500 to then say, hey, this assumption's not going to go through because Carrington just told me that they don't do investment properties, right? So we don't do any of that. And I think they actually split that up between the listing agent and the buyer's agent for the $1,500 or whatever that is. So we don't charge anything as far as like any of that. So and I don't think I went through our fees. So what we do, the way that we get paid is we charge, it's 1% of whatever the purchase price is, and it's paid as a closing cost. We charge it to the buyer. So it's just like any other closing cost. So it goes through, nothing up front, and it's only paid upon a successful closing. And like I said, even though the average out there is like 50-60% of like a success rate, we're at 100%. We've never had one that we've put into motion that has not gone through. And that's because, again, we do all of that upfront work that you were talking about, that buyer pre-screening, and we don't charge for that. So it doesn't make sense to us, or to me, to charge that.
And then one last little question. Who would do they go directly to you guys when they want the secondary financing, or would it be through one of your partners to qualify for that?
To be honest with you, kind of either. So we do secondary financing. We have the outlets for that. As far as to kind of like, again, to make it super easy. But if they're like, hey, and this has happened, my parents said that they're going to give me a loan as secondary financing, not a gift, but they're going to do a loan. Can I use them as my secondary financing? Absolutely. And we'll help facilitate that. But if they want the regular, normal, conventional financing, yeah, we have the outlets for that.
Okay. And then who would I go to ask for the recording? Because I have a lot of notes, but I feel like taking a lot of notes again on the second watch.
Sure, I can get that. I can get that over to you. It'll be myself or Joe.
I appreciate it. Thank you.
Yeah, you have to be really nice to Mike if you want that recording.
I can tell you this is the first one that we've recorded. So hopefully it worked out just fine.
Mike, can I play off that question about the pre-screening?
Sure.
If I have the listing and I put in there, that anybody that wants to buy needs to go through the pre-screening process with me.
Right.
Is that something that you guys do, or?
Yes.
Okay.
That's in that verb. Like if you remember that little Word document that was super tiny that you could barely see, it actually says it in there. It says must be pre-screened through UME Assumption Specialists, because the last thing you want to do is get a non-qualified buyer under contract in your house. And then again, it falls out 60 days later.
Okay. And if we have any more questions after this, do you have a number that we can call, or?
Yeah, I'll shoot you guys all out my contact info. I'll have everything. I'll shoot an email out that'll have like all the stuff that I showed you guys, like the PowerPoint slide. And then also included on there will be like a little Assumptions 101 thing that just kind of like gives you the the correct information for a lot of myths, like you can't do investment properties, etc. That'll all be on there. And all my contact info will be on there too.
Okay, thank you.
Hey, Mike, quick question for you.
Sure.
In regards to conveying to a buyer or a seller, in terms of, a typically done transaction, the financing in terms of closing costs, to do an assumable mortgage, is the closing cost more efficient? Like you mentioned, there's no appraisal, right? So, how do we convey that, best?
Good question. So there's two ways to do that. So if you're on let me just pull it up while I answer that. So let's go to, let's just go, since I'm right here, let's go to Mike's. So here's where you have the loan comparison, right? Well, we also have what you can do is like a fee worksheet. And then I'll explain the fee worksheet. This is, again, super easy and fast that you can send to a buyer. So you just download the fee worksheet. It's a very, very common question. What are the fees like? So this will have the fee worksheet put together. Now, and let me go through and explain all of these here. So the lender fees, the lender, that's the servicer. So we just put lender fees, so servicer fee. This is the max that they're allowed by law to charge in your region, the West region, $763. And then they also charge normally about a $75 credit report fee. Prepaid items, I put $2,000 in there. That's just my estimate for homeowners insurance, but they've got to pay their homeowners insurance up front.
Mm-hmm.
Third-party fees. You have the recording fee. So you have that's our fee is the UME Assumption Specialist fee, which is the 1% of whatever the sales price is. Title fees, does that look low to you?
Yeah.
It's low because on the buyer side, you don't have to pay for a lender's policy. So you'll have some servicers that'll they'll demand a lender's policy, like, yes, we need a lender's policy, but we always push back and get that gone because the lender's policy already exists with the current loan. So you don't reinsure it again. You don't need another lender's policy. So the buyer saves on that. They don't pay the lender's policy. They don't pay for an appraisal. Overall, it's about, I don't know, maybe 10% less expensive going through an assumption than it is regular new financing. Because again, remember, there's no other like regular lender fees that, well, they're like $2,000, and then you're not paying points on the loan. So you're not paying a point or a point and a half. None of that exists. So this is
Okay. So in general, like, you can basically say ballpark, it's probably 10% less than what you would generally go through in terms of closing costs.
Yeah.
Okay.
It's about 10, I would just say about 10% less to be conservative. And that's not really even, I mean, it's not like you go through an assumption for a savings and closing costs, right?
Right. Right.
The big like win there is the payment and the low interest rate.
Okay. And then the other question was, it's not quite that relevant, but in terms of encumbrance on the entitlements. So once a buyer takes over and assumes the mortgage, obviously that's now encumbered. What happens when that mortgage is maybe paid off, right? Like on the sale, a final sale of that property. Is that encumbrance? Does that encumbrance go away?
Yeah, it's gone.
Okay, perfect.
So then the selling veteran gets his eligibility or entitlement restored is the term for it. So it gets restored once that sells.
Thank you, Mike. Appreciate it.
And Lawrence, just to let you know, that's only with VA. With FHA, there is no encumbrance.
Got it. Yep.
Yeah, FHA, it's straightforward. Like that's why you hear me talk about VA so often, because FHA is super straightforward. Once the seller lets it be assumed, they have zero ties whatsoever in any way to that loan. They're gone.
Great. Thank you.
All right, so I'm gonna get my let's do one. I've got one. You guys can ask me as many questions as you want, but I've got one question for you guys. Let me pull it up. And if you already know the answer to this, like if you've already been through the classes or you know the answer, not just a good guess, don't spoil it. But let me bring this up and see who can get this. And it'll be the first person to like answer. Let's see here. Give me class supplements. No, that's not the one I wanted. All right. Can you guys see this? Can everybody see the logo?
Yes.
Okay. So here's the question. Because I've got a lot of friends, like when we first started, me, they're like, you've got a donkey in a suit. That's stupid. I don't get it. Can anybody get it? There's something clever behind here. What is clever about the logo? Seems like we might need a hint.
Yeah.
Okay. What is this? So
They're having
Matthew,
fun here with this.
An app.
it is a what, Diana? Or who said ass?
Sarah. I said ass.
It
Ass.
is.
Yeah.
Ass you me? I don't know.
Assume.
You know the phrase,
Assume. Who
y'all
said it?
chicken.
Matthew.
Oh.
It spells out assume. Our logo spells out assume.
Very
So-
clever.
Assumable.
No.
So
makes
Sarah
the
and
blank out
Matthew,
of-
I'm gonna write that down. I'll email you guys. And then I have like a little prize for you. It'll be a little Yumi hat. So you can have the ass on your head. All right.
Thank you.
All right. Okay, guys. Well, what other questions might you have? I think I've gone through just about everything that you guys are now experts for about the next 20 minutes until you forget all that. But I will send the email out. It'll have a summary, all the stuff here. If you guys want to dive into the website, just kind of like run through it. And then if you guys do want to sign up, I would ask Misty for the coupon code, but then you just sign up through there with the coupon code. And then, and once you do, we're actually going to have it's October 22nd. It's probably going to be about an hour and a half where it's going to be myself and my developer. We're doing another Zoom, but it's all based on the website as far as like the back end for subscribers, like how to take advantage of, like I'll give you a good example of something that's a little bit more complicated.
Next week.
22nd.
Yeah, 22nd next week.
Yeah, next week. It's on the 22nd. But like this whole client list here, this is now, it's morphing into like a pretty robust CRM to I almost want to say rival like Sync. I don't know if you guys are familiar with Sync, but there's so much stuff in here where you can create search criteria for all of your different clients that you have in there. There's just so much to it now. And so we literally go through it for like an hour and a half of like all the different applications and functionality of the website, even beyond all the, a lot of people, I don't know if you guys are like me, but I subscribe to some lender stuff and I probably use like 3 or 4 of the 30 things that they have, but they're the things that I'm like, it's worth it to me. Like this one, people love, just looks like we had a couple more just come on the market, but the newest listings feed, like some people use just that. And you only need the Jax plan, the lower plan, just to get this feed and to be able to create one search and stuff like that. And to be able to get all of the printing of the loan comparisons and all of that stuff that's in the Jax. And then it's the people that are like, I want to start, pointing my people towards my website. And they're the ones that go with the Jill's plan, because if you're going to be farming, for example, and you would probably talk to Misty about this on the marketing side. If you're going to be farming an area for trying to get listings and you're trying to express the value of, like, some of these people have government loans and and they may be looking to sell, but now you say, hey, listen, your home is more valuable than you think because you have a loan. So you're effectively selling your house and your loan. Here, take a look at my website. And then you capture all that traffic. And that's really where you're going to be more on the Jill's plan. So, or if you have buyers that are shopping, you send them to your site to shop on your site.
So, Mike, where do these properties come from? Do you take them from the MLS and then bounce them against what their loan is if it can be assumed? Or are these people that are actually saying you can assume my loan?
The first one, what you just said, we take all of the data from the MLS, right? And the data from, as far as like, that's why it's a live feed. It updates every 10 minutes. So when it updates, we then, exactly like I said, we bounce it against all of our public record sources to make sure that it's an assumable loan, and then we populate that, because the MLS itself, the assumption data, it's terrible, and it's terrible because of you guys. Because agents have to know that if it's an assumable loan to then mark it as assumable. So when it goes into the MLS, then people can see it if they search for assumptions in the MLS. So that is another thing for you guys to do, especially on the listing side, is when you go into your MLS and you do the listing, make sure you put it as assumable. So if someone doesn't know about our website and they search for assumable loans directly through the MLS, yours will show up, but only
Okay.
about 20 to 30% of the assumable loans, assumable properties actually show up on MLS.
Okay. Thank you.
All right. If we've got no more questions, feel free to contact me, give me a call, text, email, whatever. And again, you'll have an email, you'll have all my contact info. And then Sarah and Matthew, I'll reach out to you guys to see where you want me to mail you your You Me hat. But
Mike,
yeah,
I have one more thing I want to bring up before everybody jumps off the call.
Sure.
Because something that you showed me when I went to the class in person when you were here before you decided to have arthritis. Was one of the gentlemen, the young gentleman, you mentioned him in the presentation from Arizona, that has been extremely successful in listing properties utilizing this technique, for lack of a better word.
so Cody right here, can you guys see my screen still? So yeah, you're talking
He's like
about Cody,
something
he's
like
out
that.
here.
Guys, barely out of high school.
He is. It's so funny whenever I introduce him to people, because all the agents always want to talk to him because he's the one who's really put it into practice.
Right.
He's 23, but he looks like he's not 23. So I always tell everybody he did great on his SATs and he's really excited about it. But so this is a little outdated by about a week or so. So he's actually got like 24 assumptions closed, and I think he's got like a little over 20 that are still under contract right now. But he is really he's focused solely on assumptions, and the value proposition that you have as an agent with using assumptions, it's second to none for buyers and sellers, because there's nothing that really rivals it. He focuses mostly on investors. So I'd say probably a good 80% of his closings are investor focused.
Mhm.
It's not all roses. It's not like he's like, oh, hey, I just got a bunch of investors and now all I do is write contracts that get accepted. His struggle is, again, from an investor side, is finding the right assumable property with a veteran that's willing to allow his entitlement to remain encumbered. So he probably gets like a 15% of the offers that he sends out get accepted, but he is writing offers every single day. So anytime a new property that comes on that meets the criteria, I mean, so you're still working. Like, it's not like all of a sudden you get a couple of great investors and you just, sit by and drink a Mai Tai and just write an offer and it gets accepted. There's still work involved.
Oh, you mean that like at short sales where we had people here that would just be at the bar all day and they had their assistants just process them? I'll leave those people nameless, but the people here in Vegas know who I'm talking about.
Right.
The other thing is that Arizona, which is where this young gentleman is out of, right? Phoenix, that area.
Yeah.
Correct. It has a large military presence. We have the same thing here. What I'm saying is they're very similar markets. So again, there are a lot of VA loans here in Vegas and FHA loans. We have both a lot of. It is the difficulty with FHA is it has to be owner occupied, but there are people that want to buy homes that may not qualify for a new FHA loan at the new interest rate, where if they do the assumable, they can get in on that and get the lower interest rate.
Right. You guys have a huge untapped market. It's just that we have not had the bandwidth to really get as much boots on the ground as we have, say, for example, here. But you guys have like an incredible opportunity there for the early adopters. You guys have a lot of great properties out there to buy.
Yeah. Yeah. So everybody else on the webinar, I'm sorry I invited you, and now I have to get to work.
All right, everybody. All right. Well, like I said, if you guys need anything, just get in touch with me. Remember, if you're looking to sign up, get with Misty. If you guys are looking to market to, like, say, your farms and you just want to know how to do that, Misty helps with all that stuff too. So
if I want to find this for other areas or search for ourselves as part investor, is that available?
Say that again. You're kind of a little echoey.
if I wanted to like search Reno area myself or look for opportunities, is this nationwide or is it certain markets?
So I don't have Reno up and running yet, because I have to have the MLS in all the individual spots. It's California, Arizona, Colorado, Vegas right now. Reno I'm working with, but their MLS is they're very slow there. The people who administrate the MLS IDX feeds. And then parts of Florida and a couple other places, but
Be
yeah,
nice about,
what's that?
I said, be nice about Reno. They're good people up there. I
No,
have my people.
they're very nice. They are very nice.
They're just
They're just, yeah, you didn't say that.
A little, they're not slow people. They're just slower in the getting things done. All right.
And again, everybody from here, thank you, Michael. Mike.
Yes, I appreciate everybody's time.
Thank you.
And I hope you guys had a good class and it was worthwhile. And again, if you guys have any wants or needs, let me know. And then also feedback. We always appreciate feedback because hearing from you guys is how we've always improved everything that we've been doing. All right, you guys have a great one. Talk to you soon.